Uh, Good morning, friends. Good morning, friends. I welcome you on behalf of Board of Studies for yet another session on a virtual classroom session, coaching classes organized for the final students of CA by the Board of Studies as a real initiative for ensuring that everybody gets the knowledge with the renowned faculties across India for the benefit of appearing for your examination. Today, as part of the financial reporting, we will be discussing as part of this particular financial reporting session, we will discuss Ind AS 7, which is talking about statement of cash flows. So let me just start sharing my PPT and then we will start discussing. The PPT is visible on your screen, I think. So what we are going to do is to understand what is actually is a statement of cash flows. What is the meaning of cash flows is what we are going to understand. And then we will proceed with the various aspects of key definitions relating to statement of cash flows, how to prepare cash flows based on direct method and indirect method. We will have a lot of case studies for our discussions, and we will cover all the case studies which has been given in our study material. And we also have from the past question paper 2 case studies which we will work out as a problem during the session. And this is the basic structure in which I have planned for discussing this entire standard. You may know that statement of cash flows is an integral part of a financial statement prepared under Ind AS. You remember that in the first session we have discussed about Ind AS 1, presentation of financial statement, in which we said that the major components of a financial statements are balance sheet, statement of profit and loss, statement of cash flows, and then statement of changes in equity and notes on accounts. This is what we have said as the 5 integral components of financial statement according to Ind AS. So accordingly, the statement of cash flows is part of the main financial statement itself. That means whenever an entity is presenting its financial statement, it should prepare and present the cash flows as part of it. If the cash flow is not there, it is not a full-fledged Ind AS financial statement. So what is the meaning of this? We have balance sheet which talks about the position of assets and liabilities and what is the shareholders' funds. From that, anybody can guess what is the strength of the company's asset position and how it is funded. Is it funded from outside borrowing, or if it is funded using the shareholders' funds? So what is the leverage you took and what type of liquidity which they are maintaining? The balance sheet can be taken from that particular point of view. It will give a lot of ideas for the user of the financial statement. When we come to statement of profit and loss account, what is the actual operations of the company during the period and what is the total income generated from operations, from other activities, maybe other income. And then we see what are all the expenses which has been incurred during the period, whether it is a cash expenditure, non-cash expenditure like depreciation, etc. We consider that. And then we go for a provision for taxes on income, both direct taxes and indirect taxes, current taxes and deferred taxes. And then we arrive at what is your profit for the period in comprehensive income. Suppose if the entity also has another comprehensive income, we said that we will add those items minus the taxes impact on that. That shows what is the profitability for the period by the entity, by its operations. So that is why the balance sheet is talking about the assets and liabilities. The statement of profit and loss account shows how the entity is actually performed during the year and what is the profit or loss which it has created after meeting its tax liability. That is what statement of profit and loss is showing. But what happens is when you are looking into the profit and loss account, you are taking into consideration both cash expenditure and non-cash expenditure. For example, depreciation is a non-cash expenditure. Impairment loss, if you are adjusting, it's a non-cash expenditure. When you are writing down inventory, no cash outflow is happening. Non-cash expenditure is very simple. There is no outflow of cash which is happening. This is only a reduction in the value of an asset, or you create a liability and offset against the asset. To that extent, it comes into the profit and loss account. But what is not really able to be assessed based on your statement of profit and loss is what is a company's capability of generating cash and meeting its liability. For example, if I'm saying the company's profit and loss account shows 100 crores of sales, out of which 99 crore is a credit sales, and that credit sales is not collected for more than 1 year, how the company will survive? So accordingly, the user of the financial statement or the stakeholders of a particular entity should be able to understand how the company is generating its cash inflows and how it applies during the period on various activities. For example, for operation activities, it has to spend on the relevant expenditure like purchase of raw material, paying employee cost, etc. It has to spend cash on that. Similarly, there will be a holding period for debtors. There will be a holding period for inventory. To that extent, there is a requirement to invest in the working capital requirement. So that also comes as part of how it is applied. The cash which has been generated during the period is how it is applied is required to be understood by the stakeholders, because it gives a very detailed understanding that even though 100 crores of turnover has been achieved, the company is able to generate a cash flow of just 1 crore and balance the amount of cash requirement is being met, for example, by taking borrowings from the banks. It may be long-term borrowings, it may be short-term borrowings. If that position is being seen, the actual strength of the company is a little doubtful, because it is capable of making profits, but the profits is not generated in cash. In fact, people used to say that cash is the reality. Profit is not a reality. Profit is shown. Unless it is realized in cash, it is not considered as a reality. To understand what is the level at which the cash flows are generated and how the cash flows are applied and what is the closing cash and cash equivalents. I'm using another terminology, cash equivalent. We will see what is cash equivalent a little later when we are seeing the key definition. So how the cash and cash equivalent at the end of the period will be able to support the future period's cash requirement or cash outflow requirement. So this is the importance of the statement of cash flows. So it is nothing but it provides the details of how cash is generated by the entity and how it is applied during the period under consideration, whatever is the presentation at its closure. For example, if I prepare and present the statement of cash flows for the year ending 31st March 2020, please see, I'm not using asset. I'm using for the year ended March 31, 2020. That means during the entire period of 1/4/2019 to 31/3/2020, what is the cash flows which has been generated by the entity and how it is applied and what is the closing cash and cash equivalent, the user should be able to understand. A comparative study of the cash flow statement along with the profit and loss account will show whether the operations of the company is really sound or there is something which we have to be worried about. We will see that in next slide on this. So basically a statement of cash flow is a simple analysis of what is the cash inflows and what is the cash outflows. Added to that, opening cash and cash equivalent plus the cash generated minus the cash applied will be giving you the closing cash and cash equivalent. So it's a simple statement. What happens when we are talking about the structure of the cash flow statement? If I am giving in a simple statement of opening balance plus cash flows generated during the year minus cash flows applied during the year, people will not be able to understand that in a proper manner. And accordingly, Ind AS 7 says the statement of cash flow should be presented in three different activities. Operating activities, we will see what is operating activities in the next slide when we are seeing the key definition. First part starts with the operating activities. What is the cash flows which has been generated? When I'm saying generated, by means of sales, by means of other income, how much cash flow it generated, and out of which it might have spent on various activities relating to the operating, right? For example, if I'm in the trading activity, what is my cash inflow? My sales is the cash inflow. What is my cash outflow? My purchase of traded goods is a cash outflow. And what is the amount which I have given on credit sitting on the debtors, right? And what is the opening debtors? What is the closing debtor? If it increases or decreases, there is an amount which has been invested in that particular amount also, stays there. So I try to understand what is the net cash inflow or cash outflow. Sometimes negative cash inflows may also happen, like what I have explained. 100 crore of sales has been made, but 99 crore is credit sales. So to that extent, the cash flows is actually not coming in. So in that particular situation, what happens is basically that what is the cash flow generated on operating activities shows the strength of the core activities of the entity. When I say 100 crore of sales and my net operating cash inflows are negative, that shows that the company is actually making losses or making the investments are being made on the working capital, and that is funded either by the next activity, investing activity. Investing activity is actually I am investing in another entity, right? But the third one is financing activity. So if the operating activity is negative, I normally look for funding, maybe a short-term loan or a long-term loan, or maybe by means of issuing debentures, issuing shares. I'm trying to find out how I can fund my operational activity. So if I'm saying that the operating activity shows a negative net cash flow, but the financing activity shows that a positive cash flow, that means somebody has given you money, that shows that there is something which we have to worry about the particular entity. For a simple reason, you are showing a very good profit, but the profit is actually not realized. It is lying somewhere, maybe in your working capital. So to understand that, this structure of operating activities is basically starts with. What do you mean by investing activities? Any entity will be having surplus funds, right? That surplus funds, how they have invested. What is the cash inflows arising out of that? Investment is a cash outflow, but I may be receiving dividend. I may be receiving interest. Those are my inflows. How that investing activity is happening, what is the net cash flow generated or used in. When I'm saying used in, it's a negative cash flow. When I'm saying net cash flows from, means it's a positive cash flow. So investing activities, what are all the cash flows which is generated. And finally, we are talking about what is the financing activity. So what we are trying to see here, basically we are trying to see one important aspect. That important aspect is any entity should have a sufficient operating cash flows. That is an important point of indicator. Let me just tell you why cash flows are required and what is the benefit of the cash flows. You will try to understand that. In fact, I have given you an example that company is making good profits, but it's not having positive cash flows on operating activities. That itself is something which we have to worry about it. Let us try to understand. As we have said, statement of cash flows shows all revenues. So it shows all revenues and all expenses. When I am saying all revenues, including credit sales is also covered, right? But it's not giving you any cash flows. Only when it is collected, it comes as a cash flow. Till such time, it's a credit sales is not giving any cash flow. But we are taking that credit sales as part to determine our profit or loss for the particular period. So it only shows the net profit or loss for the period. Whereas statement of cash flows, as I have already discussed, it shows what is the cash received out of your activities. Activities may be, as we have said, operating activities or investing activities or it may be financing activities. How you have received from the three activities, what is the cash which you have received, and what is the cash you have used. That means what is your cash outflow in any of the three activities is what we will try to see. But interestingly, when we are seeing, our concentration will be more on company's core operation, because we are worried about how the company is performing. Profit is very great profit and it declares very good dividend, but for declaring dividend or paying the dividend, it borrows money from a bank. That itself shows something wrong with that particular financial statement. That cannot be found out from a statement of profit and loss account. Your cash inflows and outflows cannot be found out from a profit and loss account. It will only show a very green picture of that company is making good profit, good dividend track record. But when you are seeing your statement of cash flows, it will show what is your cash flows arising out of operating activities, maybe negative. And when you are making a payment of dividend for which you are not getting from the core activities, that is, you don't have a net cash inflow from core activities, you are borrowing from somebody else and making the dividend. That itself is a doubt whether the company's fundamentals are really good or not. So accordingly, statement of cash flows is one of the important tool or important statement for us to understand the company's real performance. Normally it is ignored. Frankly speaking, when somebody is reading the financial statement, they will only see what is the profit for the year, what is the dividend declared, and they will never look into the statement of profit, cash flows. If you compare the statement of cash flows, you will be able to understand whether the company is really performing well or not. But analysts are using this. When you see analysts are using this, and key management personnel, KMPs, for the purpose of investment in the company, strategic plans for surplus funds being invested in case of any, for raising funds, all those things, they are actually doing this. I can put it in a simple word. Suppose if you are looking into any company, even a small trader, he will maintain a kacha cash book. That cash book will talk about what is the opening cash balance and what is the receipts during the period, what is the amount which has been paid. That itself is nothing but a cash flow statement. Only thing is, it is an extract of cash received and cash paid. When we are putting it in a format, in a codified format into three different categories, according to Ind AS 7, we call it as a statement of cash flow. So nothing to worry about preparation of statement of cash flow, right? That is what I wanted to inject on your mind. Don't worry that this is something unusual. What I have seen in my thing is that in case if there is a gap between the net profit or loss for the period and the net cash generated in the operations, if the difference is bigger, I have to worry big, because I have shown a great profit, but in my cash flow statement I am showing a negative cash flows from operating activities. That will be a bigger concern. That is what KMPs and business analysts are normally using. Okay. Don't worry about my handwriting, because my handwriting I am using a stylus pen, and with the system I am not able to hold it very strongly. Otherwise, reasonably my handwriting will be better. Okay. This is why cash flow statement is required. I will put that into some numbers so that you will be able to understand why the cash flow statement is required. If you are thinking your career after passing CA as an analyst, where you will look into that is this particular statement rather than just looking at the profit and loss account. Profit and loss account will be the start point, but more of the inputs will be coming by means of looking at your cash flow statement. Let us take an example. What is happening in this particular situation? The company is showing is showing an income from operations of, I have taken for 3 years, so 2019, 2018 and 2017, we assume. So, if you see the sales is steadily increasing. Year on year, there is a very strong growth. 1,000 crore, maybe we will take it as crore, 1,000 crore, to 1,600 crore. That means there is a 60% increase which is happening, right? So 1,600 crore. From 1,600 crore, 2019 has gone to 4,000 crore. So very fantastic result. And if you see the operations also, it is also having an year-on-year growth from 120 to 230 and 780. You actually see that in proportion to your sales, you are actually having profits also increasing year-on-year. So anybody will look into that, or anybody who is looking into the profit and loss account will think that this company is doing fantastically. Year-on-year growth in revenue, year-on-year growth in net profit after tax, perfectly all right. But if you see the net cash from operating activities, which we prepare based on the statement of cash flows, first year it shows negative money, negative cash flows of 1,100 crore, which is coming from the operating activities. That means even though it sells 1,000 crores of turnover, it is not able to collect. Majority of the amount is sitting in the working capital limits, or it is losing somewhere, or it incurs the cash outflows, which is not being relating to the operations. Maybe another possibility could be the 1,000 crore. What we are talking about income from operations includes some one-time income or some income which is not actually realized. For example, other operating revenue is also considered as part of income from operation. Assuming that the company is entitled for certain benefits, subsidies, and they have recognized that particular item, but is not actually realized from the government. To that extent, there will be a negative cash flows, right? Or otherwise, I sell, as we have seen in the previous example, I sell in credit, but I am not able to collect it from the debtors. Entire amount is blocked in my working capital limits. That also shows that there is something wrong with the company's performance. So first year it's 1,100 crore. Second year is 1,800 crore of negative cash balance. Third year is 3,200 crore. So when sales itself is 1,600 crore and there is a negative cash flows from the operating activities of 1,800 crore, something is to be worried about this. That is the reason why we always wanted to analyze the cash flow statement also along with the profit and loss account. What might have happened if I have to look into that? Revenue from operation increases significantly year on year, but the entity has a negative cash flows from operating activities year on year, which is also increasing significantly. That is a clear net red flag that revenue reported is high, but little cash comes in. How the entity is surviving, how the entity is able to pay its expenditure. For example, when my turnover itself is 1,600 crore and I have a negative balance of 1,800 crore, how I have met my expenses for purchases and payments to the creditors, staff cost, etc., how I have made. That is a question mark. Most likely it will be surviving from cash flows from financing activity, or whatever investment I have made before, I am realizing that I am selling my investments and taking that money for the purposes of doing it. For example, I have put it in fixed deposit. When I have sufficient funds, I am withdrawing from the fixed deposit and using it. So the cash flows are not coming from the operations, the cash flows are coming from financing activity. That means I am borrowing heavily or I am liquidating all my investments. That means the company is slowly going into deep trouble, right? So this is the reason why everybody is looking for a statement of cash flows to understand. Okay? So what is the objective of cash flow statement? As I have rightly pointed out now, you understood the cash flow statement is basically for the purposes of providing information of what is the changes in cash and cash equivalent. Cash means cash balance, bank balance in current accounts, bank balance in SB accounts, whatever. But a company will not have a savings bank account. It will have only current account. What is cash equivalent? There are some items which can be readily convertible into cash without any significant risk of losing that money. For example, I have a fixed deposit. Okay, that fixed deposit can be readily liquidated and taken as a cash. Whether I will lose any money, fixed deposit, I will get that money back. Only thing is the interest component will be little bit less when I am pre-closing that. So that could be. So for example, I have invested in the preference shares of another entity, which is redeemable. That is, I have invested only for a 3 months period. And the redemption amount is very clearly known. So accordingly, whatever I have invested can be realized within 3 months time. So it is readily convertible into cash, any liquid investment which can be done. I have invested in the debentures of another entity, but has a 3 months of maturity period at the time of my investment. That is also not going to lose any amount. So I will get that money back. So that is also considered as cash equivalent, but anyway, we will see that. So what it says, what is your opening cash and cash equivalent? What is the amount which you have collected during the period? What you have paid? What is the closing cash equivalent? Is what it is trying to show you, that amount. And how the entity generates the cash and cash equivalent is another point which we have to consider when we are talking about the requirement of cash and cash equivalent. And we are also trying to find out what is the ability of the entity to generate cash and cash equivalent. So is it from operating activities? Is it from investing activities? Is it from financing activity? The stronger a company is when it generates cash flows from its core activities, because I am running the business for generating cash flows. If I am not generating cash flows by running my business, there is something which I have to worry about it. Okay. The third point is that what is the timing of the cash flows and whether it is certain that I will be generating cash and cash equivalent. For example, if I am saying I have invested in the fixed deposit and the fixed deposit will have a maturity of 12 months and above. Is it readily available? No, it is only after 12 months. If I wanted to use it or surrender it, pre-close it, I will lose some money. So accordingly, what is the timing based on which you will be having your inflows and outflows? That will also be assessed. Interestingly, the standard also says, based on the current year outflows of cash, you can also understand what could be the net present value of the future cash flows the entity will generate. You can project the cash flows by means of presently, these are all the amounts which I am having. And in case if 10% increase in your turnover, what would be the possible projected cash flows? But when you are projecting the cash flows, one of the important point is that the net present value is not same today as well as tomorrow, right? So to that extent, what is the net present value of the cash flows also you can assess. Analyst normally tries to do that particular activity. So this timing is not only for the current year. This is for current year. You can understand. We call it as historical information. Okay. And future years, future periods, we can actually understand that what is the net present value of cash flows, right? So both can be understood by reading the statement of cash flow. That is exactly is the objective of cash flows also. Let us understand that by means of a simple steps to understand the cash flows. I have already given a very simple example. It is nothing but a kacha cash book being maintained by a small vendor. Opening cash balance, what is the collections during the day, what is the payments which he has made during the period, and what is the closing balance, right? Similarly, what we are talking about in Ind AS 7 is nothing but first step is you have to see what is the opening balances of cash and cash equivalent, because that is a starting point, right? The second, the opening cash and cash equivalent is nothing but the closing balance of the previous year audited number. From that, you can actually take that. This is from previous year audited financial statement you can have. So we are talking about an Ind AS company. Naturally, they will have an audited financial statement. It's coming from the previous year audited financial statement. And then the second is, what is the cash generated during the period? What is the cash generated during the period in three different activities, from operating activities, from investing activities, from financing activities? What is the cash generated during the period? Similarly, when you generate the cash flow, related expenditure might have been spent, or you might have invested the surplus funds in some investing activities, or you might have acquired new plant and machinery for the purpose of generating cash flows from core activities. Those are considered as part of your outflows, right? So the third step is to detect the cash payments made during the period. Everywhere I am using the word during the period, please understand, it is not asset. That means for the full period, see for example, if I am preparing quarterly, then quarterly cash flow statement for full quarter, 3 months figures you have to add. When I am saying that this is yearly, then for the full year, 12 months, what is the cash inflows and what is the cash outflows? Both you have to consider as part of our cash generated during the period and cash payments made during the period. And when we are considering the cash generated or cash payments made, please understand we are using the word cash generated, cash payments. So that means any expenditure of a non-cash item or any income which is a non-cash item are normally excluded because it is not generating any cash flow. It only adjusts the balance sheet number and P&L number. It is actually not creating any cash flows. So non-cash items are excluded to arrive at what is the cash generated during the period, what is the cash payments made during. Actual cash outflow has to be considered. So what will happen? Opening balance plus cash generated minus cash payments will give you the closing balance as at the reporting period. That closing balance should be reconciled with current year cash and cash equivalent as per balance sheet. In the balance sheet, you will have cash and cash equivalent. It should match. In fact, when we are going to see the structure of the statement of cash flow, one of the disclosure requirement is that you have to show what is the components of cash and cash equivalent and how it reconciled with the balance sheet. So two disclosure requirement automatically comes in as part of the cash and cash equivalent. So it is a cross check that your cash flow statement is perfect. If there is a difference between the cash flow statement, the net cash and cash equivalent as per cash flow statement and what you are showing in the balance sheet, that means your cash flow statement is incorrect. Tallying cash flow statement itself is really an art. A lot of people used to struggle in practical scenarios, and over a period of time it will come. As far as your examination is concerned, don't worry about it because it's a simple process of identifying what is the cash flow inflows, what are all the cash outflow, what are all the non-cash items, and after eliminating the non-cash items, you have cash inflows and cash outflows. How those items has to be classified into the three buckets: operating activities, investing activities, and financing activities. Let us understand these three a little later. What do you mean by operating activities? What do you mean by investing activities? What do you mean by financing activity? Because if you understood the concept of the three, how to differentiate the three, all your problems on cash flow statement Ind AS 7 can be very, very easily solved by you. Nothing to worry. Normally my method of telling people is that don't worry about Ind AS at all because it says very detailed guidance available in the standard. If you understood the concept, you will never make an error. Accordingly, in cash flow statement also, this is not an accounting standard. You know that Ind AS can be classified into two categories. One is accounting standard and another is disclosure standard. When I am saying accounting standard, this will result in an adjustment in the profit and loss account with a consequential adjustment in your balance sheet. That's what we say accounting standard. Accounting standard also requires a disclosure to be made, respective accounting standard. For example, if I am saying Ind AS 16, property, plant and equipment, it's an accounting standard because it says when you have spent money on acquiring a property, plant and equipment or a machinery, how to account for it? Ind AS 16 says it should be shown as your non-current asset. And the amount is actually going out of your cash balance. So to that extent, the cash balance or bank balance comes down. That is also stated as part of your balance sheet. When at the year end, you have to depreciate your property, plant and equipment to reflect the current replacement cost. So you are depreciating it, debiting P&L, crediting your property, plant and equipment. So the property, plant and equipment carrying value comes down in the balance sheet, and your profit for the year is actually comes down to that extent of that. But is it a cash expenditure? It is a non-cash expenditure. So when I am charging depreciation, there is no cash outflow. What we do is, when we are considering the cash generated during the period, if we have debited the depreciation, this is a non-cash expenditure. We are adding it to the profit. Okay, we will see that how we are doing it. I'm just giving an example of how this is happening. Then the net profit is nothing but your revenue from, or net profit after adjusting the non-cash expenditure or non-cash income. You get your operating income by means of your core activity, right? But what is the amount which you have paid for purchase of your plant and machinery? You have invested to generate future cash flows by means of investing in a long-term asset or a long-term basis. When I am saying if the amount is invested in a short-term liquid funds without much difference, and it can be very easily convertible into cash or cash equivalent, we said it's part of cash and cash equivalent, right? Whereas if I'm investing on a long-term basis for future cash flow generation, we consider that purchase of fixed asset as part of investing activity, right? What is the financing activity? To purchase that particular machinery, I have taken a term loan. The term loan comes from a bank. Is it relating to my operating activities? No. Somebody is funding me. I have to repay. So that cash term loan taken is part of your financing activity. When you have a financing activity, there will be an outflow. One is repayment of loan which you will make, and also you will pay the interest. Those are also placed under the same category of financing activity. In simple terms, what is relating to your operating activities, the inflows and outflows will be shown there. Whatever is relating to investing activities, the inflows and outflow will be shown under investing activity. What is relating to financing activity will also be inflows and outflows will be shown, right? Let us try to understand this little further for the benefit of you by means of understanding the key definition. What do you mean by operating activities? With so much of discussion which I had, you might have understood operating activity is nothing but the principal revenue producing activities of the entity. In a trading case, it is sale of goods and services, right? In case of a manufacturing activity, it's a manufacturing of goods and selling. So the inflows are the revenue generated by selling. The outflows are the expenditure relating to generating this particular revenue from the principal revenue producing activities. Okay, that is the simple operating activities. What do you mean by investing activities? Acquisition and disposal of long-term assets and investments. That means I have funds. Using that funds, I am investing in long-term asset. The long-term assets may be, it can be any asset. For example, property, plant and equipment, intangible asset, all those things could be, and even investment property. Investment property comes as part of your Ind AS 40. You will be covered that particular standard separately. So these items could be a long-term asset which you are purchasing. Similarly, these assets are used to generate, are used for the purpose of generating operating cash flows. But I have invested not on immediate basis. It's for long-term purposes, so it goes as an investment activity. Sometimes these items are not generating cash flows for the revenue coring activities, but this is surplus funds which has been invested. So this will also generate cash flows. There will be cash outflow. What is cash outflow? investment which I have made in debentures, investment made in fixed deposit, all are cash outflow. What is cash inflow? Is dividend, interest, etc. or cash inflow. What could also be cash inflow when I am selling it? Sale proceeds also is my cash inflow. When I am disposing that particular investment, I get that money. That is also cash sale proceeds. That is also cash inflow. Similarly, when I am selling this particular asset after the end of the period, profit on sale is an income debited into the P&L account, whereas actual sale proceeds is what cash actually I have received. So we have to arrive at that sale proceeds. That is also part of your cash inflow in investing activities. We will see a lot of example for you to understand. I'm just giving an overall picture. And the third one is financing activity. What do you mean by financing activity? Two things which we have to see. So this is one, owner's capital, and of course financing activity also comes from borrowing. So it should owner's capital means owners are giving additional share capital, so that will be coming as part of the financing activity for the funding of this. And when I am actually getting a loan, long-term borrowings and short-term borrowings, both are also part of my financing activity because somebody else is financing my entire activity. So we have to take into consideration both. What do you mean by cash? Cash on hand and demand deposits, which can be readily converted into cash. What we have not defined is cash and cash equivalent, right? We have not defined what is cash and cash equivalent. Let us understand cash equivalent. The reason is cash and cash equivalent is nature is like this. You have to see whether it meets that criteria. It should be short-term, highly liquid investment. You should have invested in a highly liquid investment. That means at any time it can be converted into cash. So highly liquid means any time converted into cash. That is what we are saying as highly liquid. But another point is it should be short term. So if I am saying after 1 year I will make this, it is not cash and cash equivalent, because if I need the funds tomorrow, I will be able to make it out in tomorrow. So short term and highly liquid investments, that was highly liquid is nothing but readily convertible into cash and insignificant risk of change in value. What do you mean by that? For example, I have invested in a fixed deposit for 12 months. What will happen if I put that into this thing? Is it short term? No, 12 months is not a short term period. It's actually a long term. Whether it is highly liquid, yes, fixed deposit is highly liquid. I can surrender at any time. Can it be readily convertible into cash? Yes, that is also possible. But whether it is an insignificant change in value? No. Originally contracted rate of interest may be 10%. When I am converting that into cash, because immediately I am breaking it, I might be losing 2% or 3% for the premature closure of that. They will charge a penalty for the premature closure. That premature closure of the interest will defeat this particular scenario. This is also not met, but this is met in the case of this particular item. So accordingly, a fixed deposit which is having 12 months of maturity will not be considered as cash and cash equivalent. Okay? Now, let us try to understand another case. I have a fixed deposit and the fixed deposit is having less than 3 months maturity. So that means 3 months maturity at the time of deposit. This is very important. At the time of deposit, the maturity period is 3 months or less. What do you mean by that? For example, on 1st of October, I am making a fixed deposit October, November, December. Before 31st December, if it matures, right, less than 3 months maturity at the time of deposit on 1st October, I have fixed the maturity period less than 3 months. In that case, that fixed deposit, let us try to understand. Is it short term? Yes, just 3 months. Highly liquid? Yes, it can be converted because it's a bank deposit. I can convert that into readily convertible cash. That is also happening. Within 3 months, less than 3 months period, even if you are pre-closing it, right? Even if you are pre-closing it, your loss will be very, very negligible. So it is an insignificant risk of change in value. Because all the conditions are satisfied, a fixed deposit which has a original maturity of 3 months or less, 3 months or less, actually it is 3 months or less, it is not less than 3 months, 3 months or less according to the standard. If it is there, it is considered as cash and cash equivalent. Understood? 12 months fixed deposit is meeting only 2 criteria, highly liquid and readily convertible. But first criteria and last criteria it doesn't meet, and accordingly it will not be cash and cash equivalent. Let us take another example. Just for understanding, I am taking only fixed deposit and we will have a lot of other cases for understanding. Let us take another example of fixed deposit. Okay. This fixed deposit was originally put for 36 months. When I have put that 3 years back, it was 36 months. As on 31/3/20, it will be realizable. When I am saying this, the maturity is going to happen on, so maturity is on 31/5/20. So what happens? As at the reporting period of 31/3/2020, I am going to get it within next 2 months. Can I take this as part of cash and cash equivalent? Because anyway, I am going to realize it within 2 months period. Interestingly, when we are defining cash and cash equivalent, it says only if it has 3 months or less at the time of original investment, then only you can consider that as part of cash and cash equivalent. If the original maturity is, if the maturity is happening within 3 months, but originally invested for a longer period, cannot be cash and cash equivalent. This is very, very important point. Why I am saying this is that in lot of questions which you are having in your illustration, in your past examples, wherever they are trying to test you, they are giving certain fixed deposits and trying to find out whether the fixed deposit you are correctly classifying as part of cash and cash equivalent or you are showing that as part of other activities. The moment I am saying that it's not cash and cash equivalent, where the fixed deposit will go? It is an investment which I have made. So accordingly, any cash inflow, that is, any cash outflow, when I am making an investment in fixed deposit for more than 3 months, will be shown as an outflow of my investing activities. What is the inflow? When the fixed deposit matures and I am getting the money back, that is an inflow. Similarly, interest income which I have realized in cash, not interest accrued, interest realized in cash will also become my cash and cash, my cash collected or cash inflows in respect of my investing activity. So cash and cash equivalent will be only if it is 3 months or less. All other fixed deposit will be classified into investing activities, not part of operating activities or financing activities. You have to be very, very clear on this particular aspect. What is meant by short term? I have said 3 months or less. That is what from the date of acquisition. That is what important. Here I have said at the time of deposit. That is nothing but at the date of acquisition of the deposit. We don't use the word acquisition of deposit. On the date of investment in that particular FD, it should be 3 months or less maturity period. That is what called as a short term. Even if one condition is not satisfied based on our discussion, it cannot be cash and cash equivalent. You will very easily understood now what is cash and cash equivalent. You will never make an error if you are keeping this in your mind very clearly. Now, let us take this example. This is provided as part of, say, X1 is a year where I have given the details, various assets, and out of that, what you are supposed to identify is what is cash and cash equivalent. Okay? Let us take the first case. Fixed deposit with State Bank of India. Fixed deposit is normally considered as part of cash and cash equivalent. But what is the condition which is coming in? If the original maturity period at the time of acquisition is 3 months or less. So we need the additional information of what is the maturity period. So what has happened? Rate of interest, whether it makes any sense to us? Nothing. Because what is the percentage of deposit is not going to give me whether it's a cash or cash equivalent. What it simply says is that when you are going to collect it. What is our previous scenario? We said it's a short term. First condition is short term. Short term means it should be what? 3 months or less. When 3 months or less, whether fixed deposit is 3 months or less, in this particular case, it is 3 years maturity. So definitely it is not a cash and cash equivalent. It is an investment made. Okay, it is not cash and cash equivalent. Second, fixed deposit with HDFC, 10% interest. I'm not bothered about what is the rate of interest. Original term was 2 years, but due for maturity before 3 months, March 31st 20X1 means it is going to be in 36. So within 3 months it's going to mature. But what we are supposed to see, at the time of investment, it should be having original maturity of 3 months. But original term is 2 years. So accordingly, this is also not a cash and cash equivalent. We are not seeing when it is going to be matured. At the time of investment, what is the original maturity period, whether it is 3 months or less. Accordingly, this is also not cash and cash equivalent. Redeemable preference shares in ABC Limited, acquired in January 20X1 and due in 30th April. Okay. So what is the characteristics of a redeemable preference shares? Whatever I have invested, I will get the money back. Right? Whatever contracted amount, I know pretty well that I am going to get it. So, we will come into the 4 categories. First category is it should be short term. Right? What is short term? It should have a 3 months at the time of acquisition. Acquired in January 2011, say for example 2011, and due on 30th April. So, February, March, April. Within 3 months or less, it is expected to get realized at the time of acquisition itself. So first condition is satisfied. Okay, I am just putting one tick mark. First condition is satisfied. What is the second condition? It is highly liquid investment. A preference shares of a company, normally we assume that it's a quoted investment. So that means I can get this highly liquid, go to the market also in case if I wanted to sell it. So the second condition is also satisfied. Otherwise also within 3 months I will get that entire amount from the bank. So highly liquid. Readily convertible into cash. Yes. At any point of time I can go for either redemption within 3 months period or go to the market. So it can also readily convertible into cash. And the fourth condition is whether I will lose anything significantly when I am converting into cash. In this case, it's a 3 months, right? And the 3 months period, nothing is going to have a significant change in the cash inflow. The fourth condition is also satisfied. Because of that, this will be considered as part of cash and cash equivalent. Even though it's a preference share capital, it is not convertible preference share capital. It's a redeemable preference share capital. That means converted easily into cash, and original maturity is 3 months, highly liquid, no significant risk of losing on realization. So it meets the criteria of all the cases. Suppose if I am saying convertible into equity shares, this will meet the definition? First of all, on that first, whether it is a short term, maybe we'll assume that conversion will happen within 3 months. So short term, perfectly all right. Highly liquid? No, I'm not going to get any liquid funds. It will get converted into equity. The moment it get converted into equity, when I will get that money back? Only if I am going to, at the time of liquidation, I will get from the company, or otherwise I am going to the capital market. But equity rates are fluctuating based on the market value of the share, right? So, whether it is convertible into cash, easily convertible into cash, the third category will be okay, highly liquid, also possible if I'm having an active market. But the fourth condition, insignificant risk of realization, definitely will have an impact. That is the reason why convertible preference shares are not considered as cash and cash equivalent. It is considered as an investment which you have made. Similarly, any investment in equity shares also not considered to be part of cash and cash equivalent, because you have to go to the market. It depends on the market fluctuation. It is not readily, that the fourth condition will not be satisfied. Now, cash balances at various banks, all branches of all banks in India. There's a cash balance. It's a bank balance and current account. At any time I can take it. So there is no maturity period also. So it is short term, highly liquid because I can draw anytime, and it is convertible readily in cash. Yes, it's equivalent to cash actually. And fourth, whether any risk of realization, nothing. So accordingly, this will be actually considered as cash and cash equivalent. Cash balance at various banks, all international branches of Indian banks, there also the amount can be at any time transferred into India. So if I'm having no restriction, that is also equivalent to bank balances, so it can be considered. Only one possible risk which we will be talking about is that forex restatement risk. Assuming that I have kept the money in foreign currency, and foreign currency risk is there, but the foreign currency risk is not considered as an investment risk. If there is a restatement of cash and cash equivalent in foreign currency, that should be considered as a reconciling item. We will look into that separately. So for your understanding, up to this point of time, simply take that it's nothing but a cash and cash equivalent, because all four conditions are satisfied. Bank overdraft from State Bank of India 4th branch, which is a temporary overdraft, which is payable on demand, whether it is cash and cash equivalent. Interestingly, there is a significant difference from AS3, which is our cash flow statement as per our accounting standard, and Ind AS 7. Ind AS 7 says any temporary overdraft which you have taken should also be for the purposes of managing your cash and cash equivalent. And accordingly, it is not considered as a loan. It is considered as part of your cash and cash equivalent. That means I have cash balance of 10 lakhs, bank balance of 20 lakhs, and 3 months less fixed deposit is another 20 lakhs, bank overdraft of 40 lakhs. My cash and cash equivalent will be 10 lakhs of cash plus 20 lakhs of fixed deposit, which can be readily converted into cash and cash equivalent, and bank balance of 20 lakhs, 50 lakhs, minus the 40 lakhs of overdraft. So 10 lakhs will be shown as opening balance of cash and cash equivalent. Similarly, the closing balance when you are arriving at, the closing overdraft will also be reduced in arriving at that. So Ind AS says that if you are talking about a bank overdraft, that is part of cash and cash equivalent. You have to be careful on this. Bank overdraft is different from working capital limit, CC limit. CC limit is revolving credit. The difference is there. So you took the loan, every year it will be revolved. It is reviewed and it is going to be extended further because the company's business is continuing. Whereas temporary overdraft is given for a particular period. And within the particular period, you are supposed to close it. And accordingly, overdraft is different from CC limit. So CC will be treated as part of your financing activity, whereas temporary overdraft will be taken as part of your cash and cash equivalent as per Ind AS 7. What AS 3 says, AS 3 is not considering bank overdraft as part of your cash and cash equivalent. So there is a significant difference between AS 3 and Ind AS 7 with respect to bank overdraft. Treasury bills, which are 90 days maturity. So treasury bills are the entire amount, all of bills outstanding. So the entire amount will be collected on the 90th day, short term, highly liquid, readily convertible into equity. Risk of realization is not there. So this will also be considered as part of your cash and cash equivalent. Now, we have seen very clearly the definition of what is cash, what is operating activity, what is your investing activity, what is your financing activity, and also cash and cash equivalent. Why I am repeating this is that cash is nothing but cash on hand and bank balances. What is cash and cash equivalents will be your fixed deposit which are having shorter maturity period, 3 months or less, and highly liquid investments which are not having any realization risk but readily convertible into cash with original maturity of less than or equivalent to 3 months, right? We have seen that. And when we are talking about operating activities, we said what is the cash flows which are generated by the core business activity of the entity. When we said investing activity is investment in long-term assets for generating future cash flows, as well as surplus funds invested in other entities, fixed deposit or debentures of another entity, equity investment of another entity. Any item which has been invested in another entity is my investing activity. And the third category we have seen is financing activity. Financing activity is what is the changes in shareholders' infusement of funds or buyback of shares. Maybe the funds which is brought in or brought out, taken out by the shareholders is your financing activity. And what is the long-term loans which the entity has taken from others, or short-term loans which the entity has taken from others other than overdraft are considered as part of your financing activity. So we are clear on the fundamentals of this. Let us go into the presentation of statement of cash flows. As we have already seen, it has to be presented in operating activities. We said principal revenue generating activities of the entity. I have given a lot of examples, and why examples are important is the principal revenue generating activity means, revenue producing activity means, depends on the nature of business of the entity. For example, when I am saying interest income for a trading company, that is nothing but investment in a fixed deposit. So interest income also arising out of investing activities, not from the core activities. Whereas if the business of the company itself is money lending, so for example, it's a non-banking finance company, it gives loans. So the core activity itself is to give loans and to realize interest income, right? So in that case of a non-banking financial services company or NBFC, the interest income is considered as part of the principal revenue producing activities. Whereas the same interest income realized by a trading company or a manufacturing company, it is arising out of investing activities. So you have to be very, very clear. Depending upon the business of the entity, these classifications will normally come into the picture. So when in the questions, if they are giving the list of items and ask you to identify or prepare a cash flow statement showing into different activities, be careful to read the first line. XYZ Limited, a manufacturing company. If it starts that, there it shows manufacturing is the core business activity. Anything relating to fixed deposit more than 3 months is normally considered as investing activity. So you are very clear on that, right? Suppose if they are saying XYZ Limited, a banking company, then the banking company interest income is a core activity, right? And giving loan, it's a core activity. Taking loan, because it takes fixed deposit, is a core activity. So you have to be very, very clear by seeing what is the nature of the entity or the core business activities of the entity, based on which the classification will come. Be careful in reading that particular single statement which we will normally miss out. Okay, don't get carried away with the list. First to see what is the nature of the business. Then you start answering your question. That is the practical tips which I have to give. Investing activities, as we have said, acquisition and disposal of long-term asset. The long-term asset may be like what we have seen: property, plant and equipment, intangible assets, investment property. Similarly, we are purchasing debentures of another entity, we are purchasing equity shares of another entity, we are purchasing fixed deposit in another entity, and we are realizing it. Acquisition as well as disposal of long-term asset will be investing activities. What is financing activities? Financing activity is, one is contributed equity when there is a change. What could be the contributed equity? Fresh share capital issued, or buyback, that is an inflow. Buyback of shares could be a scenario where you are actually repaying the existing equity. So there is a change in the size and composition of the contributed equity from the shareholder, equity shareholders, not preference shareholders, because preference shareholders are not considered. So you have to be careful when you are talking about preference shares, whether you have to talk about this as an equity. But at the same time, second point which is saying is that borrowings, right? Preference shares, according to Ind AS 109, financial instrument, is considered as a financial liability. So financial liability is a borrowing. So what is the difference between these two? Equity investments are buyback of equity shares are part of owner's movement with the owner's equity. So you have to show that as a separate line item. If there is a preference shares which has been matured and you have repaid that particular item, then you have to show that as a separate line item. You should not mix it with the equity and borrowing. That is the only thing which you have to be careful on that. The question is, during the year, the company has issued certain preference shares and redeemed certain preference shares. Both are two different activities. For the time being, I am taking that as two different activities. Can I show on a net basis? There are some conditions which we will see on a different slide. Preferably show that realization as a, that is new issue of preference shares as a separate line item, and redemption of preference shares as a separate line item. Don't net it off. That's what the expectation, unless there are certain conditions which has been met. Okay. Preference shares is considered as borrowing, whereas equity shares are considered as transaction in the composition of the contributed equity. So both are coming as financing activity. What could be the outflows arising out of it? One is redemption of the preference shares as an outflow. Buyback of the equity shares as an outflow. What could be the other things which may happen? Dividend which you are paying on preference shares as well as in equity shares will be an outflow. Tax paid on dividend under the Income Tax Act is also an outflow. Those outflows are not investing activities or operating activities. That is also part of your financing activity. Similarly, I take a loan from a bank, a term loan. So, long-term loans taken from bank. And if you have started repaying that particular loan, you can say that long-term loans taken during the year, so much. Repayments made to long-term loans, separately you can show the repayment made during the year. And what could be the other outflows relating to long-term loans? Interest you might have paid. So interest paid should be taken into that. But interest accrued and due, that means it is not actually paid, might have been accounted as part of your expenditure in the P&L account. But when you are coming to your scenario of a cash flow statement, whether it is actually a cash paid, no, it is only accrued, non-cash expenditure. So you have to derive what is the actual amount paid, that should alone be shown here. When we are taking the indirect method in an Excel sheet, I will show you how we will do. Maybe I will also share one published accounts for the purposes of understanding how you can identify the interest accrued or interest paid during the period. There will be a difference possibly because interest debited to P&L account will be much higher, but actual interest you have paid may be lower for a simple reason. It is accrued but not payable. Only on the due date for payment you will pay that interest. Only if it is paid, it should be part of your outflow of cash. So non-cash items are not considered, right? So this is the structure of your cash flow statement. So this is what I have said. The nature of the entity's business will determine the classification of cash flows into three headings. For a financial services company, interest income is operating activities. For a non-financial services, for a normal trader or a manufacturing company, it is part of investing activities. So you have to be very, very clear on what is the business and based on which the classification should happen. Let us try to understand certain examples for operating activities. Sale of goods and services is an operating activity. Royalties, fees, commission and other revenue which you are collecting is a core activity. You might have generated a technical know-how which you are giving by collecting a royalty. You are operating for somebody else, you are collecting a fee for that, for the services rendered. You are collecting a commission when you are acting as an agent for that, or any other revenue. For example, I have a government grant which has been collected, subsidy I have collected, that is a other revenue, right? So these are relating to the core business activity. So that's the reason why we are saying, suppose if any item cannot be classified as investing activity or financing activity, but you have a dilemma whether it is really relating to your core business activity or not. First you have to see, here this comes as first question which you have to have is that whether I have to classify specifically. So specifically whether I have to classify as part of investing or by financing activity. So if I say that yes, I have to specifically classify this as investing activity, then don't take it as part of operating activity. When I am supposed to classify as part of financing activity specifically, then don't take it as part of operating activity. If it is not there, but it is relating to your operating activities, then you can include other items of income. That is the inflows. What is going to be your outflow? You might have already imagined what is that. Nothing but whatever is the expenditure relating to this. When I am saying sale of goods, there will be purchase of material. For the purpose of resale, it's a trading company, or manufacturing, raw material which I have purchased is an expenditure or cash outflow. Other manufacturing overheads like salary paid or subcontract charges which I have paid, power and fuel which I have incurred, stores and spares which I have spent, all those items are other manufacturing overheads. And employee benefit expenses. Without the employee cost, I cannot generate any revenue, right? So it's directly relating to your manufacturing activity. Even if this is one thing which I wanted to tell you, some people will think that administrative selling, suppose if it is employees or administrative employees or selling employees, whether that should be treated as part of core activities, because my core activities is manufacturing and sales. Whether it should be there, please understand, your business requires these administrative people also, right? So this is also relating to your core activities indirectly. For sales, you require a person, right? And without sales, you cannot generate your revenue. So don't get carried away by saying administrative staff salary means whether it should go to investing activity, whether it should go to selling activity, don't consider. Unless people are trying to say staff salary paid to staff engaged in the treasury operations who are managing the investing activities of that. Unless this type of specific comment comes in, you have to ask this question, whether here it says any other item not classified as investing or financing. In my example, what happens? Treasury department is maintained, and the treasury department has only one option: investing activity, nothing to do with my core operations, nothing to do with my financing activity. And accordingly, that particular employee's salary may be not relating to my operating activities, but it should be classified as part of my investing activity. Could be. But 99.99% of the cases, we never has such illustration. But having said that, I'm not able to guess what type of examiner who sets the question paper. If he is going into that, have the simple principle. If this is a business, this is a core activity. If it is core activity, any income relating to core activity is my operating activity. Any expenditure relating to core activity is my cash outflows on core activity. Simple concept I have to have. Another point before that, I have to talk about taxes paid. When I do my business, I have to pay tax, right? Is it relating to investing activity? Is it relating to business activity? Normally, it is relating to my normal business activity, and accordingly, that is also considered as part of your operating activity. Any income taxes paid should be considered, or any refund from department will be considered as part of your operating activities only, unless a portion of that has to be related to any other classification of investing or financing activity. Now we are clear about operating activities. Let us take an illustration by which we will try to understand what are the point which we are talking about as part of the particular situation, whether it is relating to operating activities or not. If it is not operating activity, where I have to put that? Okay, because we have already understood what is investing activity, what is financing activity. So here what we are saying, from the following transaction, identify which transaction will be qualified for the calculation of operating cash flows. If the company is into the business of trading mobile phones, so it is a trading company, then whatever relating to trading of mobile phones and any income arising out of that mobile phone will be my operating cash inflows. Any purchase and related cost for earning that income of in trading of mobile phone should be treated as my cash outflow. Very simple. Anything other than that is not part of my operating activities. With that, we will proceed into the question. Receipt from sale of mobile phones. What is my business? Is that trading of mobile phones. So automatically this is my cash inflow from operating activities. Perfectly correct. Purchases of mobile phone from various companies. Unless I purchase, I cannot sell. So it is also relating to my core business. It is not my property, plant and equipment because I am trading in this. Suppose if I am saying that purchase of mobile phones for the employees, then the situation changes because employees are going to use it for long-term purposes. To that extent, it is part of your investing activities, right? Whereas this is purchase of mobile phones by a company which is trading on mobile phones will be cash outflow from operating activities. Employee expenses, unless I spent on employee cost, it cannot be generated. So this is also part of my cash outflow from operating activities. Advertisement expenses, it is also part of my operating activities. Credit sales of mobile. This is also sales. Should be taken as part of my cash inflow. What is the cash which is coming out of that? It is a credit sales. So accordingly, there is no cash generated. If it is cash sales, cash is coming in. In a credit sales, I credit sales, debit my trade receivable. Accordingly, this is not a cash inflow as far as the operating activity is concerned. What could be the possible cash inflow? Out of the trade receivable, I have collected so much. That could be my cash inflow. But credit sales is a non-cash item. and accordingly not a cash and cash equivalent. Miscellaneous charges received from customers for repairs of mobiles, it is an ancillary activity to the main business, right? So this is also my cash inflow I am receiving from the customers. Loss due to decrease in market value of closing stock of old mobile phones. When the model changes, nobody buys it, and accordingly I have to give you a huge discount. As per Ind AS 2, inventory should be always measured at lower of cost and net realizable value. When I am writing down the net realizable value, is it any cash outflow happens? No. It is a non-cash item, so it should not be considered as part of my cash outflow in respect of arriving at operating cash flows. Payment to suppliers of mobile phone, yes. For the purchases, I might have taken credits purchases also. This is directly cash purchases. This is directly cash sales. And when I am saying it is a payment to the suppliers, when I have made a credit purchases, I will be repaying it. So this is a cash outflow relating to operating cash flows. Depreciation on furniture on sales showroom. Depreciation is a cash outflow? No, it is a non-cash expenditure. So it is not cash outflow. Interest paid on cash credit facility of the bank. Is it relating to operating activity? No. I have actually taken loan from the bank and for which I am paying it. So it should come to yes, financing activity. Profit on sale of old computers and printers in exchange of new laptop and printers. Profit, that means there is a sale profits also coming in. So to that extent, we have to identify, not exactly the profit on sale will come into that. You have to identify what is the sale proceeds which has been collected on this. Then we have to take into consideration. Assuming that when there is an exchange of new laptop and printer and there is no inflows and outflows, it's like 3 laptops have been shared to buy 2 laptops. No outflow has happened. Then it becomes a non-cash. In this example, since it stays profit on sale, I am assuming that I have exchanged the laptop and printer, but also got some profit. That means there is some cash inflows also came into consideration. Whether the cash inflows is relating to operating activity, my business is trading on mobile phones. There is no question of I am trading on computers and printers. And to that extent, this is relating to long-term asset, right? Long-term asset when purchased, it is investing activity. When the long-term assets have been sold, the sale proceeds are inflows from long-term asset. That is part of your investing activity and not part of your operating activity. Advance received from the customers. Customers are giving the advance, so naturally that is also my operating cash inflow. Sales tax and excise duty paid. Of course, excise duty is no more. This is an example which has been taken from old question paper. So accordingly, excise duty was there. Now GST is the only thing. Assuming that this is a GST which has been paid is relating to your core activity. So this will also be part of your cash and cash equivalent. Okay. Part of your cash flows from operating activities. So what we are trying to do to understand simply, we are trying to understand what exactly is the business of the entity. What is relating to the core business we are considering as part of cash inflows or outflows. If it is non-cash item, we are not considering that. So simple. Now, before I go into the further slides, what I will do is I will download the questions which you people have asked so far. Okay. So, and then I will answer those questions as of now. During the period where it is getting downloaded, what I will do is I will also move to the next slide on investing activities. Till such time it is actually downloading, let me just take the question. What is investing activity? What is investing activity? As we have said, It is for examples are sale of property, plant and equipment is inflow, insurance proceed for damage of property, plant and equipment, any collection in respect of you have given a loan. It's an investing activity. When you are collecting that loan, repayment which has been collected from the party who has taken loan is an inflow of that. Where you have sold an equity instrument of another entity, it's also part of it. Suppose if it is equity instrument of entity's own shares, is it part of investing activity? No, it is part of raising funds. So it is financing activity. So that is a cash inflow. Cash outflow, acquisition of equity instruments of other entities, not my own shares I cannot purchase. Accordingly, it is an investment or acquisition in another entity. Purchase of property, plant and equipment and any other assets like furniture, office equipment, etc. for the businesses. Even if I am making a leasehold improvements in LSC, so 3 years I have taken a lease and I am making a leasehold improvements, that is also my cash outflow for investing activities. Before we get into the next slide, let me take the questions which has been asked by you as of now, and then we will go for our break. Don't worry about my, okay, I will try to change my camera position. So let us just understand what we are, what you people have asked. What I will do is that if I have already answered certain questions by asking my own frequently asked question or taking some illustration, I have answered that. I will not answer those questions. I will say that we have already answered and we will proceed further on that particular situation. 1 second. I have to align this also. Okay. So the first question which is coming in is from Lokesh Mittal. Is it necessary to prepare cash flow statement when company is preparing account on cash basis? When you are talking about Ind AS companies, I'm just giving an example. Ind AS companies are not permitted to prepare on a cash basis, right? Accordingly, this question is not relating to Ind AS companies. So if you are applying Ind AS 7, mandatorily you have to prepare cash flow statement, and your accounts are prepared on mercantile basis. So there is no possibility of you are saying that I am preparing on cash basis. So for Ind AS companies, this is not relevant. Assuming that we are talking about other than Ind AS companies. Under the Companies Act, whether you can prepare on cash basis, not permitted. So any company cannot prepare on cash basis. So to that extent, cash flow statement will become mandatory in respect of Ind AS companies. In respect of other than Ind AS companies, there is a limit which has been given. Small and medium-sized companies and non-small and medium-sized companies. You might have already heard about it as part of your Companies Act. And in Schedule 3 also we have discussed about that. When you are talking about that particular category, small companies are exempted from preparing the cash flow statement. Non-small companies is nothing but where the turnover is more than 50 crore and the borrowings are more than 10 crore. Then they are considered as a non-SMC. They have to mandatorily prepare cash flow statement. Assuming that it's not a non-corporate, it is not a company, it is a non-corporate entity, then AS3 says level 1, level 2, level 3 classification, which you might have read it in your IPCC itself. Level 1 entities are mandatorily to prepare cash flow statement irrespective of whether you are preparing on cash basis or not. Okay. So if it is a cash basis, it will be like a direct method. We will see that a little later. So mandatory is based on the company's, legal form of the particular entity. If it's a non-corporate entity, if it is level 1, it is applicable. If it is company not following Ind AS, if it is a non-SMC, small and medium company, non-small and medium company, it is applicable. If it is an Ind AS, it's a mandatory because it is integral part of the financial statement. Then Aruna is actually giving that any time limit for cash equivalent. We have already discussed about the 3 months or less. taking classes of cash flows for inter, but no other teacher taught this practical aspect of cash flow. Okay, thank you, Sagar. That is one of the reason why I am coming in for making you to practically able to understand the concept, and based on that concept, you will be able to answer your questions. That is what the understanding which we are trying to do. So in those scenarios, you are expected to be able to understand each and every aspect of the concept. Because I always believe that if you are strong in the concept, you will never make an error. That is the reason why Board of Studies is actually planning for this type of thing. If financials are prepared on cash basis, we have already discussed about that. What is the difference between AS and Ind AS? I have certain slides, Stravani. After the end of the session, we will discuss that. Finance taken for working capital will be classified as, we will come to that anyway. When you are taking a finance for working capital, it will be treated as part of your financing activity. Just to answer. There is one server down for yesterday evening. Let me just, I think it's up now. Otherwise, I may not be able to see your question. Short-term asset will also considered in the investment activity if it is not highly liquid assets and insignificant risk of recovery is not there. Those items will go as part of your investing activity, even if it is short-term. For example, if I am saying I have made an investment in equity shares, or maybe I have made an investment in preference shares in respect of unlisted company, and those preference shares are not having an active market, and there is a possibility that it is not redeemable preference shares. So to that extent, there is a possibility of risk, even if it is a 3 months period, and accordingly this will go to investment. So you have to find out whether all the 4 conditions have been satisfied. If all the 4 conditions are satisfied, then it becomes cash and cash equivalent. Even if one condition is not satisfied, you have to put it in your investing activity if it is relating to investment in other entities, or financing activities if it is you are taking finance from other entities. Investment made for short term, I have already explained this, Neelam. What about banks' financial activity, which can be called as operating activities? I will come with an example for the bank's financial activities when we are talking about overall category of this. I have one example for you to answer. Income received from non-performance of my business from the competitors. Such income, okay. I think Sasikumar's question from Tirupur is that non-competing fees which I have taken from a competitor, and that has been collected in cash. I mean, collected in cash means I have inflow has come. Bank account is also considered as cash. Don't say that cash means cash. Cash includes bank, right? So when I am receiving a non-competing fee from my competitors for the purposes of not doing the business, it is also arising out of my core business activity only. So we will consider that as part of activities. But having said that, if it's a non-competing fee, see, actually when I am talking about a particular standard, I won't stop at the particular standard. You people are expected to be potential chartered accountants on a go-forward basis, right? So you should always have a holistic approach. The moment I am saying there is a non-competing fee which is coming in cash flow statement, yes, it's a core business activity. But at the same time, when you prepare a financial statement, it triggers an event called discontinuing operations, right? You are going to discontinue an operation based on an agreement with a particular party. So your financial statement presentation itself will undergo a change. And there is a requirement to make disclosure as per Ind AS 105. Whenever you are reading a concept, please try to connect with whether any other Ind AS will also apply. Then your concept will be 100% correct, boss. So that is what my suggestion. So in this case, it is part of core business activity, but at the same time triggers discontinuing operations related in the presentation of financial statement and Ind AS 105 related disclosures, because it is relating to discontinued operations of an entity. Fixed deposit should be part of investing activities or cash and cash equivalent. Does it depend on tenure? Anupam, we have already discussed that. If the fixed deposit is 3 months or less original maturity, at the time of putting the deposit, it's 3 months or less. then it becomes cash and cash equivalent. If it is given for 12 months, but shown as part of my, but it's going to mature within 3 months from the end of the reporting period, still it is not considered as cash and cash equivalent. It will be part of your investing activity. If it is given for more than 12 months, automatically it becomes an investing activity. But only point is, within 12 months in the financial statement, Ind AS 1, if you remember that, we have seen the format of the balance sheet where we have said bank balances other than the above, we have shown as part of current assets. So that means any fixed deposit which is not having original maturity of less than 3 months or less will not be part of cash and cash equivalent, but will be shown as bank balances other than above under current asset. If it is going to mature after 12 months from the end of the reporting period, then it will be treated as bank balances under non-current asset as per Ind AS 1. Other than cash and cash equivalent, that is any fixed deposit at the time of original investment is less than 3 months or equivalent to 3 months, all other bank deposits will be treated as part of your investing activity. When it matures also, it is considered as part of investing activities inflow. How much time can it be set short term? We have already discussed that. Insignificant risk of change in value will consider only principal value. You have to check relating to losing of return on the same. Samyuk, when we are talking about a principal alone, every fixed deposit will also qualify for that, right? But at the same time, when you have agreed for an interest of, say, for example, 15%, but the company in which you have made the deposit could not pay that amount, your return is also going to get affected. So you have to consider both. 3 months is time used to identify readily convertible. No, it is not readily convertible. 3 months is the maturity period. Okay, when you are going to collect it. Readily convertible, it's a short-term investment. In fact, the 3 months or less is attributable to the first condition, short-term investment. Readily convertible is basically whether it can be converted easily into cash. Fixed deposit can convert into cash very easily. That's the reason why. But exactly the 3 months period is relating to short-term conditions. Gold be considered as cash and cash equivalent? Definitely no, because gold is relating to a lot of market risk. So accordingly, you will not know exactly what is the amount which you have invested, which you are going to collect it. So it will be part of your investment activity. How it is possible that original period 36 months turn out to become realizable this yearly? So very simple, Mayuri, what I am talking about, maybe you have missed it. 36 months is the fixed deposit originally I have made 3 years back. But maturity period, assuming that maturity period is 31/5/2020, when I originally made the deposit in, say, 19, 18, 17. In 2017, May, I have made the deposit. So 3 months, 3 years will be ending in 2020 May, right? So in 31st March 2020, it's going to be realizable in next 12 months. But original maturity period and the date of acquisition is more than 3 months, right? That is the reason why. I think you have missed it when I was explaining this. In the exams, will the questions be purely numerical based or combination of numerical and theory? I have seen both are there, boss. Is it possible to solve problems of old AS by applying the provisions of current Ind AS? You can still do that. It's not a problem, except one major problem, the OD limit. No, OD is considered as part of cash and cash equivalent here. It is part of your borrowings in AS3. So you can still be able to answer with whatever you are learning from here, you can be able to do. FD 3 years back, but mature within 3 months from the end of the reporting period, whether cash and cash equivalent. Animardhan, we have already said that original, on the date of original investment, you have to see what is the period for which it has been made. If it is more than 3 months, then it will not be cash and cash equivalent. In your question, it is more than 3 months, and accordingly, it will not be considered a cash and cash equivalent. Auto renewal clause in FD would make any difference while deciding cash and cash equivalent? No, it is only a procedural aspect. So, what is the period for which you are auto renewing it? For example, every 3 months you are going to auto renew it. So that means still on the date of renewal, it has original maturity of only 3 months or less. So it will continue to be cash and cash equivalent. So it doesn't make any difference. What is the period for which it is renewed is the problem. Okay. If the beta of stock is near 1, can we say that it is cash equivalent? No. Stock inventory will never be part of your short term, so it has to be treated separately, part of your operating activities. If bank OD is not paid on demand due to bad customer, so you are the bad customer, right? But still, it's an overdraft facility. When you took the loan, it is part of your cash and cash equivalent. Whether it is repayable on, it's already repayable on demand, but you have to consider that as part of cash and cash equivalent only in Ind AS 7 alone, not for AS 3. Overdraft I have already explained. Cash and cash equivalent, what will be the treatment of cash equivalent under the Ind AS 7 we have already discussed. Gold and silver I have already explained. First two are not okay, you have already explained that. We have taken each and every item. Recently some banks failed. How the balance with those banks should be treated? Anurag, very interesting question. That is the reason why Ind AS 109 financial instrument says when you are working out expected credit loss, you should consider even bank balances for the assessment. So on that basis, if you are saying that the bank will not be able to pay, you might have fully provided for it. So your cash and cash equivalent will become 0. And it is a non-cash item which has been adjusted. So to that extent, it becomes a non-cash adjustment in the bank, in the profit and loss account, but continue to be cash and cash equivalent. But the problem is whether you will be able to collect it. No. So to that extent, it will not be part of your cash and cash equivalent. And normally that amount will be 0 when I am saying that expected credit loss has been attributed to a bank which has been failed. Investing activities for entities involved in investing activity. I'm not sure what you are talking about, Shravani. Maybe when you are seeing this particular slide, because we have talked about the investing activities after, before I have opened this, so you have an answer for that. Do we have to prepare, I'm not sure, something is missing, Prakash. Whether financing done for securitization of asset done be covered in financing activity or operating activity or investing activity. Definitely financing activity, it is not part of your operating activity, because anything relating to sale of your fund, when you are doing a securitization, you are talking about trade receivable. That's the reason why you are having a doubt. But if I am a manufacturing company or a trading company, securitization is not normal core business activity. So it will go to investing activity or financing activity depending upon what is the nature. If loan taken from one scheme is converted into another scheme, okay, this I will keep this question pending because we have to talk about financing activity, then we will come into that. Banking company, which will be the classification for fixed deposit made with RBI, it's part of the core business activity. So that should be what is the classification. You said mobile phones given to employees is investment activity. Can we not consider it benefit to employees and consider it as operating activity only? Shailaja, a good interpretation. But in the example when I am talking about, I have said mobile phones given to employees but capitalized as part of property, plant and equipment. That means company owns the asset, only usage has been given to them, not free of cost. It's not a gift which has been given. And accordingly, I have taken as property, plant and equipment. So to that extent, it becomes an investing activity. But in your understanding, what I am trying to understand is that you are giving that as a free mobile phone to the employees, maybe as a gift for long-term service in the company. In that case, it debited to the P&L account as employee cost, then it becomes operating cost. Okay. So these are all the questions came up to that particular point. Continue to post your questions and I will be happy to take that questions. What we will do is we will take a 5 minutes break and then we will come back and discuss this further. Okay. 5 minutes break. I am going to disconnect my video and audio for a time being. Can we proceed? Okay. So we have seen up to investing activities, and also we have understood what is the requirement of cash flows, what do you mean by cash and cash equivalent, what do you mean by the three classification of operating activities, investing activities, etc., and complete examples for operating activities. Investing activities, I said that I will hold for a moment because we have to answer certain questions to you. So what I'm doing is I'm just taking another example. If you see that, I'm taking another example of the case where somebody has asked that question also relating to banking company, right? So what is the question which is coming in? From the following transaction taken from a private sector bank operating in India, identify which transactions will be classified as operating and which will be classified as investing. So they are asking both the questions. I wanted you to understand what do you mean by operating activities, what do you mean by investing activities. And what is a business? We said that the starting point should be identify what is a business. This is a private sector bank, right? It's a private sector bank. So accordingly, the business itself is to give loans, take deposits, take a spread of that. Interest income will be inflows, interest paid will be outflows. So we know what is the core business of the entity is as of now. So on that basis, let us just move on to understand each and every item. Interest received on loan, that is my core activity, right? Because it's my core activity, this is my operating. Okay, when I'm making it as a tick mark, you consider that as an operating, because writing is becoming little problem with the stylus. So what you can actually take it as, if I'm making a single tick, it is an operating activity. If I'm making double tick, it is an investing activity. But I will explain that. Interest paid on deposit, I take deposit and I am giving a loan. So naturally, this is directly relating to my core business activity. So that is also operating activity. Deposit accepted. When I am accepting deposit, is it a borrowing? No. For me, that is the main source. So this is also considered as part of my operating activity or my working capital assessment. Loans given to customers. When you are giving to the customer becomes a trade receivable for you. So this is also part of your operating cash outflow. Loans repaid by the customer is collection from the customer. So it is relating to operating activities, cash inflows. Deposits repaid. You took the deposit from the public and you are repaying it. So repayment is an outflow but relating directly to your core business activity. So that is also relating to your business activity. Commission received. Commission received. See, when you are actually giving, for example, bank guarantee. For bank guarantee, you normally charge some commission. So it is relating to your main activity or ancillary activity. So that is also part of your operating activity. Lease rent paid for various branches. Without rent, you cannot run any business. So this is also relating to your business operating activities. Service tax paid. We have told that any taxes payable to the government will be, if it is relating to the operating activities, should be treated as part of your operating activities. So this is also operating activity. Furniture purchased for new businesses, new branches. Is it my core activity? No. Accordingly, it is definitely not operating activity. But when I am saying furniture, it's purchase of long-term asset. So it is part of my investing activity. Implementation of upgraded banking software. Again, on intangible assets, I am investing. So this is also investing on a long-term asset becomes an investing activity. Purchase of shares of 100% subsidiary for opening a branch in Abu Dhabi. I am investing in another branch. So this is an investment made. Definitely not operating activity, even though it's a branch activity. It's a long-term investment. to that extent, it is part of my investing activity. New cars purchased from Honda dealer in exchange of old cars and remaining amount paid in cash. Only the remaining amount which has been paid in cash we have to consider, right? But what to do? What is the nature of the transaction? It's a new car purchased. So new car is not relating to my core activity. It is relating to purchase of long-term asset. In exchange of the old car will be extinguished from the financial statement and new car will come into the picture, but the capitalization will be in respect of the amount actually I have paid. The amount paid in cash, this alone will be treated as investing activity. Not the entire cost of the new car will be shown as investing activity, and the value of the exchange of the old car will be treated as my cash receipt. So you should not consider that. The net amount which has been paid in cash alone has to be considered as part of your investing activity. Provident fund paid for the employees is part of employee cost. So core activity, operating activities to be classified. Issued employee stock option. Okay. Issued employee stock option. Is it operating activity, investing activity, financing activity? So one moment if you think, you will find out that it's only option issued, but no cash is collected, no cash outflow has happened, and accordingly this is a non-cash item. A non-cash item should not be part of our cash flow statement. So out of the 15 items, one item is a non-cash item. All other items are depending upon the nature of the business we have classified. Somebody has asked this question. If it is a banking company, what you will do? For a banking company, the classification will be based on what is the core activity. Taking loans, giving loans, interest receipt, interest payment, and related activities. So on that basis, we are doing it. Any long-term investment, it's always treated as an investing activity. But issued employee stock option, I am not collecting any money. There is no cash inflow. There is no cash outflow. It is a non-cash expenditure. If it is debited to the profit and loss account, we will adjust this as a non-cash item. We'll come to that little later. So now you are clear on investing activity because a lot of people have asked about what is investing activity as question, and I said that I will take it little later. Okay. Now, for a few moments, I am not taking my video. Don't worry about the video because I wanted to preserve some bandwidth. I will explain. My audio will be okay for you. Financing activity. What do you mean by financing activity? Any cash inflow which is coming in. Examples are like, I have invested my equity instrument. I have issued equity instruments. I have issued bonds. I have taken short-term or long-term borrowing from others. And I paid a dividend or interest on the borrowings or debentures, etc. And any dividends which has been paid, any other distribution which has been paid to the owners of equity instrument, repayment of amount borrowed and related interest cost, principal amounts. This is an interesting point. I took it because normally this is a twister which can be considered in your question paper. That is the reason why I took this example. Suppose if you are buying from a creditor, right? So the trade creditor, when we are trade payable or trade creditor, assuming that it is being paid in the normal period, normal credit period of 90 days or 120 days or something like that. Instead, if the creditor actually gives you 3 years for repayment and staggered annual installment of 3 years, 3 annual installments over 3 years period, whether it is a core business activity, even though trade payable is connected with my working capital and core business activity, but the creditor actually gives me a long-term funding. And to that extent, I have to consider this particular creditor outside the working capital limit and take it as my financing activity. So the repayment of principal will be treated as part of my financing activity. When I took this extended credit period from the creditor, that creditor will be removed from your operating activity and shown as part of your financing activity, saying that deferred payment credit received. Okay. So in respect of deferred payment credit received, you don't have any actual outflow. But when you are repaying it, it should hit your financing activity and not part of your operating activity. That is an important point which you have to consider. I have seen in a very, very old question paper this particular case. That is the reason why I picked up. Now, let us try to understand. Now we have understood operating activity, we have understood investing activity, and we have also understood what is financing activity. Let us have a combined scenario. Whether this is operating activity, investing activity, or financing activity. Issued preference shares, I think that there is one error. Nature of transaction, not nature if transaction. You can correct it in your background material. Nature of transaction. Issued preference shares. Preference shares are long-term in nature, and it is actually for the purposes of funding. It is not, I am not invested, but I have taken this, so this will automatically go to finance. Okay, can we have, okay, let me put it as the alphabet, that is a better way. Purchase the shares of 100% a subsidiary company. I have invested in another company on a long-term basis, so investment activity. Dividend received from shares of subsidiary, cash inflow arising out of investment activity. Dividend received from other companies, no difference, that is also investment activity. Bonus shares issued. Is there any cash inflows or outflows arising out of it? Bonus shares are issued free of cost by capitalization of your profits, right? So in that case, there is no cash inflow or no cash outflow. Bonus shares will not come as part of cash flow statement. One point which I have not talked about, non-cash item. I have a separate slide. In case of non-cash transactions happened, it should be disclosed as part of your notes and accounts. Because it's not reflected in the cash flow statement, it should be disclosed as part of your notes and accounts. So any bonus shares issued will be part of your notes and accounts. For example, when we are talking about the share capital, under the share capital, any bonus issue made in the last 5 years has to be disclosed. There you disclose what is the bonus shares which has been issued during the particular period, but it should not come as part of your cash flow statement. Purchase license for manufacturing of special drugs. Here, one thing which we have not done, what is the business of the entity? It says multiple business, multiple segment. So that means it may be manufacturing, it may be trading, it may be in other business also. So multiple segment, they are in business activity, not in investment activity. That's very clear. So because it's a special drugs for which they are purchasing the license is a long term. So it is an investment. It's like a technical know-how you are purchasing or a trademark which you are purchasing. Like that, it's a long-term investment in intangible asset. So it's a investing activity. Royalty received from goods patented by the company. So I have a technical know-how. I have given that for use by others for which I am collecting the business. This is relating to my operating activity. Because core business itself, other income is arising for the operating activity. Rent received from the let out building, letting is not main business. So when I am not having the main business of letting out, this will become my investment activity cash inflow. Because my investment is investment in investment property as per Ind AS 40. Okay. Any rental receipts not relating to the main business will automatically become my investment income. So investment activity. Interest received from loans and advances given. Interest received from loans and advances given. In this case, we are talking about multiple business, multiple segment. It is not very clear whether they are actually into money lending also or financial services, assuming that they are not in financial services. I'm just giving you. They are not into financial services. In that particular situation, interest received from loans and advances given is nothing but my investing activity, because I am investing in other person's business by giving loan. Dividend paid, what we have said, because it's a payment to the shareholders, to that extent we have to consider it as part of financing activity. I'm not sure. In this case, they have said that it's a preference shares dividend or equity shares dividend. In both the scenario, it will be financing activity. One inference you can take from the example, they have issued preference shares during the year, so there is a dividend paid during the year on preference shares also, or maybe on equity shares. But in both the cases, the difference is there is no difference. It will be classified as an outflow under financing activity. Interest paid on security deposit. When I took the security deposit, it is like I have taken a financing from other party, and accordingly any interest paid will also be for my financing activity expenditure outflow. Purchased goodwill is nothing but my long-term asset, so investing activity. Acquired the assets of a company by issue of equity shares, not parting any cash. Spent a moment on this. Acquired the assets of a company by issue of equity shares, not parting any cash. Whether it will be part of cash and cash equivalent, cash flow statement? No, because no inflow or outflow of cash which has happened, and accordingly should not be part of the statement of cash flow statement. So normally we get carried away. Acquired assets of 10,000 rupees for which shares of 10,000 rupees has been issued. So immediately what we will do is we will show 10,000 as an outflow in investing activity, and issued shares 10,000 as financing activity. We will show that as inflow. So net the cash flow statement will tally. Whether it's correct? No, because it's a non-cash item. So to that extent, it is not possible for showing this. Having said that, you remember that here I have talked about disclosure in the notes. Here also you require a disclosure in the notes saying that during the year the company has issued so much of equity shares for purchasing the business of so and so entity for a consideration of so much. And of course there is one more standard which comes in Ind AS 103 business combination. That standard also requires a lot of disclosure to be done, but it's a non-cash. Suppose if they are saying total consideration is 20 lakhs, out of which 15 lakhs is equity shares issued, balance has been paid in cash. That 5 lakhs alone should be part of your investing activity, because you are purchasing a business, right? So it will come as part of your investing activity, 5 lakhs alone, not the entire 20 lakhs and 15 lakhs shown as cash outflow. Interim dividends paid. Any dividend which you have paid, whether it's a final dividend or interim dividend, is relating to your financing activity because you have raised funds and you are paying it. Dissolve the 100% subsidiary and receive the amount in final settlement. Any investment which I have made in another entity, whether it's a subsidiary, associate or joint venture, I am supposed to show that as part of my investing activity when I disposed of the subsidiary and I have received amount, right? That will be part of my investing activity cash flow. Now you must be very, very clear on how to identify what is relating to operating activities, what is relating to investing activities, what is relating to financing activities. Perfectly correct. Now we will move to the next one. How the cash flow statements are presented. There are two methods which has been given. One is the direct method and another is indirect method. What do you mean by direct method? I will identify from the cash book what are the items of cash inflow, what are all the items of cash outflow. When I am saying cash book and bank book. So what are all the possible inflows which will be there? Cash purchases will be an outflow. Sorry, we are talking about inflow, right? Cash sales. Other than that, maybe some miscellaneous fee, commission or other items which has been received could be your amount. So since it is part of direct, I will show on the face of operating activities cash collected on sales so much, cash collected on other operating revenues so much. That is what the inflow I will take. Whatever is the outflow relating to that. For example, raw material purchase payment which I have made to creditors, I will show that as a separate line item. Salary paid, I will show as a separate line item. So like this, what is relating to operating activities, I will show as a aggregated based on the nature of the items on the face of the cash flow statement. That is called direct method. But preparing a direct method, it is a little bit cumbersome and it is not actually giving you a proper understanding and connected with the financial statement. In simple terms, if I'm saying purchase of so much as my payout in direct method, how I can relate that number in any of the other balance sheet, cross-refer with any other balance sheet item or P&L item, it will be very difficult for me to do that. And that is the reason why people are believing that we will not prefer this method. So it is an option available, but preferred method is this. When I'm saying two ticks, it's the preferred method. This method is permitted, but normally not used by companies. Only industry as of now is using is insurance companies. Insurance companies are using this method. All other companies are not using the direct method, and majority of the India's companies will use only indirect method because insurance companies not yet the roadmap is applicable. What is indirect method? I will not try to identify what is the exact cash flow for purchases, exact cash flow for sales, but I will try to arrive at indirectly. How I will do that? I will take my profit as per profit and loss account as the starting point. On that item, what are all the non-cash items which has been included? I will add up that items if it is an expenditure and reduce the items which are non-cash income. Arrive at what is the net cash flows I have generated. Can I stop at that level? No. Because of the core activity, I might be having opening debtors and closing debtors. There is a change in the debtors. Suppose if the debtor has increased, what does it mean? I have actually taken a credit purchase, and to that extent, there is no outflow which is happening. There is actually, I have taken a market credit. So the working capital changes are also adjusted. Whatever items which are relating to the working capital, I normally adjust those items. How we will do? We will compare the items in the current period in the balance sheet vis-a-vis what is the previous period balance. Difference between these two will increase my working capital limit or decrease my working capital limit, I will consider. So profit as per profit and loss account, add non-cash expenditure, deduct non-cash income. Then I will adjust for working capital changes. This is the net cash flow which has been received from operating activities. And what we have been told, any taxes paid should be considered as an income from operating activities unless there is a specific reason why you have to classify somewhere else. Assuming that I have paid income tax, then income tax should be reduced from that, and the balance is nothing but cash flows from operating activities during the period. Okay. Similarly, because you have added some non-cash items or added an item which has to be when I am saying this indirect method, to arrive at the operating activities, I have only talked about non-cash item, non-cash income, right? One more item which has to be adjusted is, suppose an item has to be reclassified under any other category, but it is debited or credited to the P&L account. For example, interest income is credited to the P&L account, whereas those items are not relating to my operating activity. It should be classified as part of my investing activity, interest income. So I will add up that particular item. I will reduce that because it's interest income. I reduce that and show that as a inflow under investing activities. So operating activities cash inflow is reduced and it is reclassified as part of my investing activities. So any item which has to be classified under investing activities or operating activities, if it is debited or credited to the P&L account, that will also be readjusted for that particular purpose. This is the way in which we will create. Okay. And when we are seeing that direct method, for simple items, as I've said, income of cash nature minus expenses of cash nature minus what is the changes in working capital, what is the amount collected from debtors, what is the amount collected from paid to the creditors, what is the amount collected from my, say for example, inventories, changes in inventory. That means it's a sales which has been collected. So those items will be adjusted for arriving at your direct method of cash transaction. That will give you your cash flows from operating activity, and plus or minus cash flows in investing activities and financing activities will give you what is the changes in cash and cash equivalent during the period. Plus the opening balance give you the closing balance. The closing balance should match with your balance sheet number. Okay, this is direct method. Indirect method is, I will start with net income. Net income is nothing but net profit as per profit and loss account minus non-cash income minus expenses of non-cash item. Actually, you can add along with that also items to be classified under investment or financing activity. So those items should also be classification adjustment. If you are adding it here, then you will deduct that as a cash outflow there. If you are reducing it, you will add it as a cash inflow there. Okay. So that if you are doing that, you will arrive at your operating activities, then investing activities and financing activities, then the cash and cash equivalent will come in. Okay. So when we are saying that working capital changes, this is what we are talking about, working capital changes for various that do not involve a cash flow. This is what we are talking about, non-cash nature. So for example, I have talked about the restatement of a debtor or restatement of a loan. For that, foreign currency losses has been booked. So that reduces my profit, right? But is it a cash outflow? No, it is only restatement, debited P&L, credited on the liability side. So accordingly, that will be considered as a adjustment for the non-cash item. So I will add up that expenditure to arrive at what is the cash actually collected from the operations. Okay. To that extent, when I am showing that investing operation, when I am talking about the loan has been increased, loan minus the restated forex losses, then what is the net balance as of this year end compared to the previous year end? The difference is my investing activities inflow or outflow. Suppose if the loan has reduced, that means that I have repaid it. I will show that as a repayment. In respect of financing activity, sorry, not investing activity. It's a financing activity because I have taken the loan, right? So that is what it says. Do not involve cash flow, should be adjusted from the profit as per profit and loss account to arrive at. Similarly, the movement in current asset and current liabilities is what we are saying, this working capital changes. Inventory, debtors, creditors, your provision, liabilities, etc. relating to the business. So all those items are working capital changes. I will show you a final working which we have done for a listed company and how we have done that as part of our discussion. But before that, let us understand and stick on to your study material first. On your understanding, I will show something else and you can think about doing it at a later point of time. So how we have to report? We said gross basis you have to report the cash inflows and cash outflows unless the cash are permitted to be reported on net basis. What do you mean by permitted to report on net basis? You have a legal right to set off that. For example, if I am saying I have taken a working capital limit from a bank and I have also repaid that loan to the bank, a partial repayment has been made. So net amount I can show. Short-term borrowings from banks, within bracket net I can show. Term loans received from the banks, net of repayments I can show. So because that is a loan which has been reduced, I took the cash inflow and repaid it. Where I have taken, say for example, issued a equity instrument. That equity instrument collection has been received. So I have to show that on a gross basis. And when I am actually buying a portion of the previously issued shares, it is not relating to the same share. So I will show that bought back as an outflow. So it is simply, is it legally available for you set off? Then in that case, you normally go for that. What it says that, these are all the examples. Cash receipts and payments on behalf of the customers rather than those of the entity. For example, demand deposit acceptance as well as repayment by a bank. They can show on a net basis. Funds held by customers by an investment entity can be shown. Rent collected on behalf of the owners of the property as well as paid. For example, rent paid and sublet lease income received. You can show on a net basis. It is also possible. And where the turnover is quick. For example, principal amount on credit card customers, I can show on a net basis. Okay, whatever collection, what is the amount which has been paid. Purchase and sale of investment, I can show on a net basis. Short-term borrowings and long-term borrowings which has been collected. These are all examples. It is not an exhaustive list. So you can show that on a net basis for the purposes of understanding that why should I unnecessarily confuse by showing two different items. But normally you have to have a legal right for offset. So what it says is that if there is a fixed maturity date, it is giving some guidance in respect of deposit with a fixed maturity date, acceptance as well as repayment. Placement of deposit. I am making an investment and this is a liability, whereas this is a payment and I am withdrawing from the payment. Here also net basis is possible. Advances or loans made to customers and repayment of that. That could also be part of it. Is because in all these cases you are going to get a net collection, right? And accordingly it is possible for you to show on a net basis. Now, one thing which we have discussed, right? When I said if you have a foreign currency bank account and on the foreign currency bank account, when you are restating, there is some unrealized gain which is coming in or unrealized loss which is coming in. You might have debited to the P&L account, which you have to add it back. Because this foreign currency transactions or foreign operations which you are talking about, if it is relating to cash and cash equivalent, you have to show as part of reconciling the cash and cash equivalent. If it is relating to any investment, you will go into the particular operation. So what it says that if you know that foreign currency transaction and foreign operations, you know pretty well, right? So one thing is we have a standard called Ind AS 21. This Ind AS 21 is equivalent to AS 11. In AS 11, what it says, you are supposed to translate the cash flows of foreign currency used in the financial statement. That's what it's required to be done. And using the exchange rate at the time of cash flows, that is on the transaction date. And you can also use a weighted average rate. And whatever difference which is realized will be part of your P&L account. If it is unrealized, to that extent, if it is relating to your cash and cash equivalent, you will show as a reconciling item of reconciling item of CCE, cash and cash equivalent. What do you mean by that? You have actually having a balance in the books only, say for example, $100. What is $100? Original investment is 45 rupees, which is an average rate. So 100 into 45, 4,500 will be shown as part of your opening cash and cash equivalent. And that is restated based on the revised number in the current period, assuming that it's 50 rupees. 500 rupees comes as an adjustment. What you will show is the opening cash and cash equivalent. Adjustment required for foreign currency changes in cash and cash equivalent 500. And then what is your net cash and cash equivalent, net changes in cash and cash equivalent from operating activities, investing activities and financing activity. If you add up all the three, that will be equivalent to your closing cash and cash equivalent as per the balance sheet. So this will be shown as a reconciling item. To that extent, it relates into cash and cash equivalent. For all the other items, it will be treated as a normal adjustment. If it is realized, it goes as part of your operating activity or investing activity, depending upon that. For example, foreign operations may be an investing activity, whereas foreign currency transaction will be an operating activity. So it will go into that particular situation. Suppose if it is unrealized, it is a non-cash expenditure, so it will be added and deducted in the respective items. We will see how we will add and deduct the particular item. Let us take one case study for you to understand. I think I have already explained. What it says is that we have 1 lakh on the opening date US dollar and 1,02,000 US dollar at the end of the period. Exchange rate on 2001 is 45 and 2002 is 50. The increase in the balance is credited in the amount of interest credited in that particular year. So deposit reported will be 45 lakhs in the opening balance, and that is on 31/12. That's the date on which they have made the investment, and that is going to be collected within 3 months. So to that extent, it's a cash and cash equivalent. So be always careful. Okay. So 3 months or less, right? We are preparing this as part of your cash and cash equivalent. This is a deposit in bank where we are talking about any specific thing. Okay. Here they are not given anything. We assume that this deposit is nothing but bank balance, current account balance. Because if you are considering that as part of your fixed deposit, the entire thing will completely change because it's not cash and cash equivalent. It is silent on that. If it is silent on this, the deposit gives a misleading statement for me. I assume that it's a current account balance for the purpose of making you to understand this particular restatement. What I will do is I restate this number from 45 lakhs to 51 lakhs, right? But what is my figure? 6 lakhs is actually arising out of what is the number? This is originally is considered at 1 lakh at 45 rupees is 45 lakhs, and another 1 lakh, 1 lakh into 5 rupees increase. That is nothing but 5 lakhs is actually coming out of my current period opening balance restatement. So if I am considering that as part of my interest income, it is incorrect. So I add this, I deduct this from my income from operations and show that as an adjustment into my cash and cash equivalent in the cash flow statement. Cash and cash equivalent, opening cash and cash equivalent, because in the last period I have reported 45 lakhs. I cannot change that. I will take that 45 lakhs and then add foreign currency changes 5 lakhs, then becomes 50 lakhs, and 1 lakh is nothing but 2 lakh into 50 rupees is 1 lakh rupees. Automatically that is taken care in the closing balance. So the 5 lakhs you will show as part of your reconciling item in the cash and cash equivalent on the assumption that this bank deposit is nothing but a current bank account. Otherwise what happens is, when I have given a deposit in 2011 December and it is 2012 December, then it becomes a issue of whether it is a deposit having more than 3 months maturity period. So in that case, I should not consider it as cash and cash equivalent. I should consider it as part of my investment activity. So that's the reason I'm asking you to check. This deposit is nothing but current deposit, not fixed deposit. Okay, for you to understand. So how it will be presented? What is the cash flows from operating activities? A. Cash flows from investing activities. B. Cash flows from financing activity. C. Net movement in cash and cash equivalent during the period is A plus B plus C. Add opening balance of cash and cash equivalent 45 lakhs. Add foreign currency adjustment on cash and cash equivalent 5 lakhs. Subtotal of that will be closing cash equivalent asset 31st December 2012. That amount will match with my balance sheet. So what we have done, interest income, we have removed it from there and showing that 5 lakhs as part of our adjustment in cash and cash equivalent. So any item which I am removing from one side has to have a corresponding impact. Otherwise cash flow statement will not tally. So whenever you are doing that type of adjustment, you always consider when you prepare a final accounts, what you do, if there is an adjustment which is given as an other information, you have a debit in one side and credit in one side, right? Instead of using debit and credit, I am just using, if you are going to add it as part of your income from operation, because it's a interest income in this case, we cannot add it as an income, right? It is already included as part of net profit. So we have to reduce it to arrive at our investment in cash and cash equivalent. So we are reducing and arriving at what is our operating activities. And then because I have reduced it from here, in some area I have to add it. That is where I am adding with the opening balance, add the impact of forex restatement 5 lakh rupees. Then the cash flow will automatically change. Similarly, when you are classifying an item in the P&L, there is an interest income which has been credited. I'm just giving another example, not relating to that. Interest income is credited, but you have to show that as part of your investing activities. So you will reduce it from your operating activity and show that as an income or inflow from investing activity. One credit, one debit, or one increase, one decrease, decrease, one increase. Like that, you should always have that for the purposes of understanding. Interest income and dividend income, depending upon the nature of the business, it will change. We have seen for a banking company, all these items are relating to interest in paid is relating to operating activity. Interest and dividend received is part of your operating activity for a financial services sector. Whereas other entities, it is part of the financing activity if it is interest paid. When you have received the interest, it's an investment paid, so it is going to investment activity. Whereas if I am talking about dividends paid, it is shares which I have issued to the shareholders. Both issue is also part of my financing activity and the dividend paid is also financing activity. Right? Cash could outpay the interest and dividend based on the nature of the business. Or just the company has invested in a 5-year bond of another company. That means it's an investment activity. Invest in another company. You can identify where it should be classified based on whatever we have discussed so far. Face value is 10 lakhs, but what is actually invested is only 5 lakhs. If you see that only 5 lakhs has been invested, what does it mean? On the 5-year end, on the 5-year end, 5 lakhs which I have invested will become 10 lakhs. That means interest is accumulating on that with the effective interest rate of 15%. So interest is also not collected year on year, right? The question is, in the P&L, what they will do, we have to account on accrual basis. On accrual basis, what is the interest for each of the year I have to recognize? What I will do, I will debit my bond with the interest accrued, credit interest income. That is the way in which my profit and loss account will be prepared. So my profit for the year includes an interest income of whatever amount. So assuming that it is I'm just giving some number, 15% on 5 lakh rupees is how much is 7.5 lakhs, right? 5 lakhs means this is 75,000 rupees. So I'm just taking straight away 75,000 rupees is the first year interest accrued. So in my P&L, I have added this, so net profit as per profit and loss account will include that 75,000 rupees, whereas it is not actually collected. So from the profit as per profit and loss account, I will add interest income 75,000. I will reduce because no cash inflow came in. So I will reduce 75,000 rupees. I have reduced it. So income from operation is properly stated. What I have to do on this 75,000 rupees? Can I show as part of my inflow under investing activities? So because I have invested, can it be an inflow in respect of investing activity? But if you see this example, they are only saying 5 lakh I have invested, I will get 10 lakhs on maturity of 5 years. That means it is only interest accrued but not collected. So non-cash item. So non-cash item cannot come as part of my cash flow statement. So if I am not putting that number in my cash flow statement, it will not match. My cash flow statement will not match because I have reduced it from operating activities. Where it will have an impact? It will have an impact on what is the closing balance of my bond. In the balance sheet, the 75,000 is added to the bond of 5 lakh. Bond is now shown at 5 lakh 75,000. If I have to see the movement between 5 lakh 75,000 and 5 lakh, there should be an increase of 75,000 which I have to show as an outflow. But really there is no outflow because that is also non-cash item. So that amount which I have reduced from there is automatically not included as cash inflow in this cash flow will tally. Okay. So the question is how interest income will be treated in the cash flow statement. It is a non-cash item and accordingly not shown as part of that. On maturity 10 lakhs which has been received, whether I have to show, the next question is split between interest income and investment activity. Yes, because interest income is also arising out of investment activity, but original investment I have made is only 5 lakh. So my outflow was 5 lakhs. So the inflow should also be 5 lakhs, but the balance is nothing but accrued interest which I have collected. So that 5 lakhs will also be shown separately, not 10 lakhs as redemption of investment made. I will show redemption of investment 5 lakh and interest income of 5 lakhs on the date of maturity. This is for accumulated bond. Suppose if I am saying bond of 5 lakhs, face value of 5 lakhs, 15% interest every year. What will happen is 5 lakh is shown as my investment in the year of a deposit. So in the investing activity, I will show investment into ventures 5 lakh rupees. Finish. Interest income is credited to the P&L account but collected, right? 75,000 rupees. So I will reduce from operating activity, reclassify as an inflow under investing activity. So you have to always identify whether actual cash inflow came in or not came in. Okay. On that basis, you have to do that. Investment in associate and subsidiaries, what it says is that it should be always shown as a separate line item because people should know that you have made an investment in your associate, joint venture and subsidiaries, and accordingly it is a change in your ownership. So for example, I have made an investment and acquired a subsidiary. People should know that I have a subsidiary. And when I have sold a portion of my investment, I will get a cash flow. I may be losing control of the subsidiary and becomes it's only an associate. So that should be very clearly visible on the face of it. Okay, that's what it actually expects you to show that on a separate line item. Taxes on income, we have already discussed that it should be classified as part of operating activity. Only exception is unless they can be classified specifically relating to investing activities or financing activity. Let us take one example for you to understand this. X Limited has paid an advance tax of 5,30,000 during the year. Out of the tax paid, 30,000 is relating to long-term capital gain. So that means business income is only 5 lakhs, right? And balance 30,000 is relating to my long-term in capital gain. Long-term investment or long-term capital gain will come from investment. So investment, the moment I say, it goes to investing activity. Whereas this 5 lakh is advance tax paid for my business income. So if it is business income, it is nothing but operating activity, right? So in the cash flow statement, normally the cash will be shown as part of my cash flows in respect of taxes will be shown as part of my operating activity. But in this particular case, it is a portion is relating to long-term capital gain. Going by the previous thing, unless they can be specifically identified for financing or investing activity. In this case, I can identify specifically for investing activity. 30,000 will be shown as an outflow under investing activity. 5 lakh will be shown as an outflow in operating activity. This also came in one of your past examination question paper. Somebody has asked whether it will be only narrative or it will also be numerical. Both could be possible. So in this case, it's a narrative plus numerical, right? So you have to explain why you are doing it. Non-cash financing and investing activities, they don't involve any cash. We have already taken that particular item. For example, a debenture has been converted into equity. Nothing is actually cash inflows into cash outflows. So sometimes an asset has been purchased and a debenture has been issued. So nothing is cash outflow or cash inflow. So in those circumstances, it is considered as a non-cash item and accordingly not reported in the cash flow statement. But what it says is that narrative format should be summarized in a schedule, normally notes and accounts. In the notes and accounts, you are, sorry. So in the notes on accounts, you are supposed to show as part of your in the notes, you will show about what is the changes which has happened in your share capital as well as your repayment of debenture, but it is a non-cash item, so you will show that as separately in your part of it. For example, we have seen that in this case, they have acquired a fixed asset of 10 lakhs by accepting a liability of 8 lakhs. So balance is paid in cash. So the 2 lakh alone will be shown as part of your acquisition, but you will make a cross reference to a narrative note saying that actual cost of purchase of fixed asset is 10 lakhs, out of which a liability has been taken from Y Limited. The example could be Y Limited is having a land and buildings. And it has taken a bank loan for that. We are taking over the land and buildings along with the bank loan. So 10 lakhs is the value of the land and buildings. So I will debit fixed assets 10 lakhs, credit bank loan 8 lakh rupees, 2 lakh rupees I will pay out of my bank balance. So that 2 lakh rupees will be shown as my cash outflow and the narrative will be explained as part of the notes and accounts. A lot of major disclosure, you are supposed to see what is the component of cash and cash equivalent. Cash balance, bank balance, in current accounts, in other bank accounts, in fixed deposit with original maturity of less than or equivalent to 3 months, and other liquid investments having original maturity of 3 months or less, and less bank overdraft in case if it is there. You will show the component and reconcile that number with what you are showing in the balance sheet. Okay. Another interesting point which they are saying is that suppose if I have cash and cash equivalent in the books, but I am not able to quickly use it. For example, I have a current account balance in a bank in Israel, and that bank balance cannot be transferred because there is a restriction which has been imposed. That becomes it's a restricted cash. Somebody has asked a question in first session. What is restricted cash? When there is a long-term severe funds transfer restriction. So what it says is that when you show that as part of cash and cash equivalent, because it's part of your bank balance. So because it's a bank balance, it's not a fixed deposit, you show that as CCE, but at the same time, this is not readily available for use. So because it is not readily available for use, what you are supposed to do is you have to show that as part of note in cash flow statement. So it is not part of financial statement. In the notes on accounts for cash flow statement, you should say out of the above cash and cash equivalent, bank balance of rupees so much held in so and so country or so and so bank is not readily available because of the restriction on transfer of funds. You have to make a disclosure. Suppose if you are buying a subsidiary or you have lost a control on subsidiary, that should be specifically disclosed about the total consideration paid and what is the cash and cash equivalent in which you have actually obtained control or lost. So nothing but when I purchased a subsidiary, I should show investment in subsidiary so much. When I have sold the subsidiary but retained a portion which is less than 50% but more than 20%, I will show that the sale proceeds on sale of subsidiary as rupees so much. So you must be able to show that in a consolidated financial statement. Previously it was part of my cash and cash equivalent, because line by line when I am consolidating, subsidiaries cash and cash equivalent will become my cash and cash equivalent. When this control has been lost, you have to explain that also. Compared to the previous period, there is something which has been lost. You have to explain that also as a disclosure. Somebody has asked me, what is the major differences between what you call AS3 and Ind AS 7? One major difference is bank overdraft. AS3 is silent, and we normally don't take it, as we take it as part of our financing activity. Lot of examples are given. So this is only a guidance. The Ind AS 7 is actually giving a lot of guidances to you. So I will not say that it's a difference, but it is more sophisticated illustration. Somebody has asked a question, no, can I use this principle for AS3 also? You can use it, except bank overdraft. But the guidance can also be used for your AS3 preparation. So it is more elaborate guidance. Consolidated financial statement, when you prepare the effect of undistributed profits of associate, that means there is an amount which has been sitting in that, there is a non-controlling interest related that, there is a guidance which says that it has to be adjusted in arriving at your cash flows. That type of specific guidance is not available, but the treatment is remaining the same. Extraordinary activities, AS3 allows you to show that extraordinary item. But Ind AS, if you remember that on the first session we have said, no extraordinary items are considered as per Ind AS 1. Accordingly, Ind AS 7 is not giving you any guidance in respect of extraordinary item. No item can be shown as an extraordinary cash flows. Changes in ownership interest of subsidiary, lot of guidances. It is actually part of financing activity because you are doing it. No such requirement has been specifically given. Subsidiaries, associate and joint venture, this I will, for the time being, I will skip. Maybe we will discuss that. You can ask this question when somebody is doing this part of Ind AS 109. Because at this point of time I will confuse you, so I will not do that. Different terminology is being used. For example, we are talking about functional currency, whereas AS3 is talking about reporting currency. It does not deal with functional currency. It talks about reporting currency. Disclosures are more extensive here, but it is not like that in AS3. This is the thing is over. What I will do now is I will download the questions which you people have now posted as part of the session, and you can continue to post it. And before I download, what I will also do is that I wanted to take 2 Excel examples which I have already taken part of your handout I have actually given. So I will take this example. One second. I will first close this. You are able to see the screen with an Excel sheet here. You are able to see the Excel screen here. Somebody can help me out. Are you able to see or not able to see? I think the administrator is also not available. I will assume that we have the. Can somebody post it in the question thing? Are you able to see? Can you post it whether you are able to see the Excel screen? Can you post it in your question paper? Say that it is available for you. I will refresh the question. So if somebody has posted it, it will be helpful. You are able to see that. Okay. I will download the questions first and I will answer them one by one. Before that, I will take these 2 Excel sheets for you so that you will be able to see. I am taking 3 examples for you to understand. The 3 examples are one on your indirect method, another is on your direct method, and one second. Okay. So now I'm trying to answer that the questions. I will take it little later because most of the questions I might have answered. But let us work on the Excel file for you to understand. Here, what we are saying is that we are. I will take the illustration 2 first because it is on direct method, and then we will confuse it with an indirect method. If you see that what they have given is nothing but a bank account. What I have told, whatever is your cash inflows and outflows in a Kacha cash book, that is nothing but your cash flow statement. Instead of taking the opening balance and closing balance as it is, we are starting with what is the operating cash flows, investing cash flows, and financing cash flows, and then net cash inflows and net changes in cash and cash equivalent during the period. We are arriving at the number A plus B plus C, and later on what we are trying to say is that what is the opening balance? Automatically the closing balance comes in, right? Now this question is already there. I'm just taking, this is your opening balance, right? Okay. This is your opening balance. So this opening balance I'm not touching. This is the closing balance I'm not touching. Let us first see from this particular side, each and every item. When we are seeing issue of equity shares, is it an inflow? Because all these items are inflows, right? Is it an inflow? Yes. Where it has to be classified? It should be classified as part of your finance activity, because issue of equity shares, sale process received is financing activity. Receipt from customers are core business activity. This is my operating cash flow. Sale of fixed asset, any investment made in long-term assets and related thing is part of your investing activity. Even though we have 3 different cash flow, but 3 cash flow related item, what we are trying to say is that each item should be classified differently. What is payment to creditors relating to my operating activity, right? Purchase of fixed asset, long-term investment in assets, so investing activity. Overhead expenses relating to business is operating activity. Payroll expenses, operating activity. Tax payment should be treated as part of operating activity is what specifically we have discussed. Dividend paid is relating to your financing activity because it is an issue of shares which we have done. A repayment of bank loan is also borrowing which I have done, so it is also relating to financing activity. So we have identified each item, right? So my suggestion, when you are appearing for your examination, if it is a direct payment, you don't have an issue. Direct answer like this, simple 2-mark or 4-mark question, you can straight away answer it. Otherwise, my suggestion, because this is the way in which in 1980 to 83, when I learned my BCom, one of my professor used to open up all the items in one single page. For example, manufacturing account, a trading account, balance sheet, working notes, everything he will open. So in your examination, you can keep 3 different pages for that, including one on working notes, and then start working simultaneously. In this example, when it's a cash flow statement, my suggestion is start with the heading, say cash flow statement for the year ended March 31, 2020. Then it's a direct method, right? So cash flows from operating activities. Add all the items which are there, but don't start with that. You will miss it. So just give some space and then say a subtotal. That subtotal you will show that cash flows from operating activity less taxes paid. Then subtotal A. Then give some space. Then next line, cash flows from investing activities. Give some space. Then cash flow from financing activity. Give some space. B and C subtotal also you can make. Then you say net changes in cash and cash equivalent during the period, A plus B plus C. Then you say opening cash and cash equivalent. That is 50 rupees. You can straight away put that number. And then closing cash and cash equivalent should be sum total of that. That should match with 150. Then your working is correct. So I am also doing the same thing by putting this here. What I have done, I have started with operating activities. Then I have taken investing activities, and I have also shown that financing activity, net increase in cash and cash equivalent. Of course, it's better to use the word cash and cash equivalent rather than cash. Cash at the beginning of the period is 50, cash at the end of the period 150. My suggestion is it is actually taken from one of the example, but always use the word cash and cash equivalent. You will get a better mark because it's not actually cash. It's a bank balance, right? So it's equivalent to cash and cash equivalent. So in this example, what we are actually trying to do is that, anecdote makes an. So whatever we have done, we have put that number from customers, we have taken as an income. Now, when I am saying open everything, what I will try to do is very simple. I will just read these items. This is my issue from equity shares, should be shown as part of my financing activity. Straight away go to the financing activity, issue from equity instrument. Receipt from customers, operating activity, top line, put that 2,800. Sale of fixed asset should go to investing activity. Go to the investing activity, pass it. So all the 3 in one stroke we have done. Now come to the other side. Payment of creditors, operating activity, post it in operating activity. Purchase of fixed assets, investing activity, post it in investing activity. Overhead, operating activity. Payroll, operating activity. Tax payment, we have put that subtotal, and then payment of taxes, put that there. Dividend, your financing activity. Your bank loan repayment is your financing activity. Now subtotal A plus B plus C, then you will get what you are seeing here. What is the advantage of opening everything in one stroke? You will never make an error. If you are just trying to identify operating activities and then investing activities and then this, when you are seeing through the problem, some item you may miss it. Whereas you open everything, start posting everything one by one, straight away. Debit side is over, credit side is over. Then you have this total, right? I have done a cross check whether that number is matching with my 150 rupees of closing balance or not. If it is not matching, something you have missed it. That's what you have to understand. This is on direct method. Very simple, but normally companies will not do. We are going for the same item, both direct method and indirect method. In this case, what I have given, this is an indirect way of asking you to find out the numbers. What it has given, they have given only an operating statement, nothing but profit and loss account. From the profit and loss account, you have to arrive at your cash flow statement for the operating activities alone, but you may have certain items which is included for financing activities or investing activities. That we have to see. So, if I am going for a direct method, I have to identify what is the actual cash which I have collected by means of sales, right? So 5 lakh is the sales which they have given. But in case if they are saying there is some additional information with respect to my debtors and creditors, I have to see out of my trade receivable, previously it is 7,000, now it is 10,000. That means 3,000 rupees of credit sales is not collected. So to that extent, there is an adjustment which I have to make on this 5 lakh rupees, right? Similarly, for each item, 3,50,000 purchases. On purchases, what is the change in my creditors? This is the thing which I have to see. In creditors, 4,000 rupees of increase is happening. That means I never paid it. So 3.5 lakhs minus the balance is what I have paid. Administrative and selling expenses. Is there any salary payable or administrative expenses? For expenses also there is an increase of 3,000 rupees. Adjust that liability. And depreciation is a non-cash item. So add it as part of your indirect method. You will adjust it. In direct method it will not participate in any place. Interest paid, I am showing that as part of my profit before tax, right? So the 3,000 interest paid is nothing but financing activity. I have to go and show that as part of the financing activity. Loss on sale of asset, 2,000 rupees. But whether it's a proceeds from sale of asset, I have to see what is the amount, what is the movement which is happening. 65,000 is the original item and it has become 75,000. And what is the movement which is happening on that? One is the depreciation. So 65,000 rupees minus 7,000 rupees must be what? My WDV. And say for example 65 minus 7 is my 58,000. 58 minus 75,000 rupees should be net increase in new investment in fixed asset after adjusting the cash inflow for sale of the asset. So that should be taken into consideration. Interest paid, if there is an interest accrued and paid, that should be considered. Fortunately, it is not there. Loss on sale of asset we have considered. Taxes paid, we have to see whether tax payable there is a provision increase or decrease. Fortunately, there is nothing. So that 30,000 is considered as a outflow straight away. Then you have to consider each and every change in this particular item. As I have said, 65 minus 7,000 rupees of depreciation will bring it to 58 minus 75,000 is the net increase in fixed thing. I have made an investment of another 2,000 rupees. I have to consider it as the investing activity. And there is a reduction in the inventory. To that extent, there is a outflow which is happening in operating activity. Trade receivable, we have already adjusted that number. Cash and cash equivalent, opening balance, closing balance. Similarly, shareholders fund, new shares came in, 10,000. Should be shown as part of investing activity. Financing activity. Non-current liabilities, 35,000 becomes 33,000. That means there is 2,000 rupees of repayment which has happened. That should be part of my financing activity. Trade payable we have already considered, payable we have considered. So, when I am taking a direct method, what I have done is cash sales of 5 lakh plus opening creditors minus closing creditors will give me, debtors, opening debtor minus closing debtor will give me 4,97,000. That is what I have done, right? Similarly, for purchase account, 3.45 lakhs is started with 3.5 lakhs. Inventory also can be adjusted here to identify the adjustment, or inventory you can show that separately also. This is the net payment made to creditor. For expenses, I have seen that opening payable and closing payable, there is an adjustment. To that extent, that amount is also adjusted. This is your direct method. So direct method, you have to have your working number, and based on which you have done this. Okay, this is coming out of that. And next one, indirect method, when we are saying, what we will do, we will start from profit as per profit and loss account, and we will adjust the items. Non-cash items are added. Loss on sale of asset is also non-cash item. Interest has to be reclassified separately. And then inventory, movement in inventory is a working capital changes we adjust. Trade payable and trade receivable is working capital changes. Then it becomes 70. So whether you are putting on direct method or indirect method, your income from operation remains the same. It will never change. Here also 70, here also it is 70. This is the other one. This illustration I will give it to you. Okay. You can do that and post in case if there are any doubt. This is nothing but you have to see the movement from one account to another account. What are all the movements, whatever we have seen in illustration 1, you have to actually see that. Now I will go to your questions and I will answer the question because we are already 7 minutes slow, and I will answer the questions. If there are anything is left out, we will see. This you work as a homework and come back to me. Whatever doubts which you are having, you can post it in BOS site itself, and they will direct it to me. Up to what we have already talked about. We have talked about proposed dividend is the new one. CC limit, up to CC limit, we have talked about. Interest on CC limit is part of operating activities or financing activities. We have said that it's a financing activities because it's a short-term borrowing. Borrowing should be classified as part of your financing activity, and to that extent, your related expenses should also be considered as an outflow in financing activity. Proposed dividend for current financial year, what type of activity? Non-cash item. And proposed dividend is not even considered as part of your, what I should say, a provision according to Ind AS 1. It is a non-adjustment expenditure as per Schedule 3, right, with Ind AS 1. And accordingly, it will only come in the notes and accounts for the financial statement and not part of cash flow statement at all. It is a non-cash item, so it will not come as part of that. What activities buyback of share? When you have issued shares, it becomes a financing activity. When you are buying the share, buying the shares back, it is an outflow from financing activity. Difference, I have said only overdraft is being considered as cash and cash equivalent. All other items are not having any difference. We have discussed that. Thank you, Parvinder, for your appreciation. What is inefficient risk of change in value? Say, 100 rupees is my investment. If I am going to get 100 rupees, but that will be considered as there is no significant risk at all. Insignificant, not inefficient, insignificant risk. 100 rupees I am investing, say 0.001 is going to be lost. Insufficient, what I call, I also get carried away with very inefficient, insignificant risk of recovery. So insignificant means you are going to get almost 100% of the principal. That's what the consideration. Sneha, thank you for your appreciation. Long-term assets sold as scrap. What is the nature of the activity? So long-term assets sold as scrap. It is not profit on sale of asset or profit on sale of fixed asset, because in your account you might have written off the entire asset. So that is a non-cash expenditure debited to the P&L account. So it will be added to part of your profit and loss account to arrive at your operating profits. Scrap sales normally considered as part of your sale process, as your operating activities. So accordingly, it's a very negligible amount. You can show that as part of the operating activity under other income, because only sale proceeds on sale of long-term asset is supposed to come in. Scrap sales is not considered as a sale process. You can still show as part of the operating activity. Gold and silver I have already explained. Taxes paid for previous year because of demand notice, is it operating activity? Yes. Any taxes paid, whether it's for the current period or previous period, it has to be shown as taxes paid under operating activity itself. Even if there is an appeal which you have lost and because of that you are paying for a previous year, should be shown as part of that. But having said that, because it's relating to the previous year tax, in the profit and loss account, you will show that as a separate line item. Profit before tax, then provision for tax, current tax, and then current tax for earlier years. You will show that as a separate line item, which is a presentation requirement as per Schedule 3. But in cash flow statement, you need not show what is current year tax and what is previous year tax. You need not show them. Can you explain why it is classified as investing activities for capital leases and leasehold improvements made by the lessee? See, when I am saying I am taking a property on lease, for example, I have taken a land on lease and I am constructing a superstructure. That is also nothing but my actual investment in long-term asset. That's the reason why we are considering as part of investing activities. It is not a financing activity. If I have purchased a machinery and the machinery is coming by means of a financing lease, right? In that case, I took a borrowing as well as I took purchased a property. Both will be classified. One under investment activity, purchase of property will come, and loan taken from a bank, term loan or a leasing loan taken from a NBFC will be shown as part of my financing activity. Whereas in the example, we are talking about I have taken a land on lease on which I construct a superstructure, which I will use, say for example, 30 years. In that case, it's an investment in long-term asset, and that is the reason why it should be treated as investing activity. Applicability of CFS for small entities, I have said, if it is AS3, then the category of small entity or small and medium companies will come in. Under India 7, there is no such exemption available because all companies are big companies, right? Leasehold improvements made by lessor is investing activity. Leasehold improvements by the lessee is the asset which the lessee is making. Suppose if the lessor himself is making leasehold improvements, that becomes an investment activity for them also because they are also investing on this. In the case, they will be only collecting operating leases. Okay, it is not an asset which has been given on finance lease. In that case also, it is an investing activity. Treatment of bank overdraft as per AS3. AS3, it is treated as part of borrowing. That means it's part of the financing activity. Whereas in India 7, it's not a carve out. It is a difference between India 7 and AS3. Because IAS 7 is also saying that bank overdraft is part of cash and cash equivalent. We have taken the same thing. So the carve out means between IAS and India, if there is a change, then it's a carve out. So it is not a carve out. It's a difference between AS3 and India 7. Rahul, thank you again for your appreciation. And there are some more sessions which Board of Studies have been allocated to you. I try to live up to all of your expectation. Gold and silver, we have already discussed that. In case gold and silver is a jewelry, because Pragar Khanna is asking a different question. Suppose if it's a jewelry where gold and silver is being purchased and traded, then core activity is dealing with that. It becomes an inventory. Then there is no investment. So it becomes operating activity. So based on the business of the entity, you decide what is the treatment. In this example, suppose core activity is something else, it becomes an investing activity. If it is a jewelry, then it becomes an operating activity. Thus, written off bad debts comes an operating activity. It is a non-cash expenditure. When you are writing off bad debts, no cash outflow. But if you are doing an indirect method, profit before taxes is after adjusting this number. To arrive at your cash flows from operating activity, this non-cash item of expenditure should be added back. What about license fee in case of telecommunication companies? License fees for telecommunication companies is an intangible asset because it has an economic useful life for more than 1 year. It is an investment in long-term asset, so it is an investing activity.
How will a deposit receipt be classified for a banking business? Is it operating and financing activity? We have already discussed Priyadarshini. It is part of the operating activities. Why the interest on cash credit is considered as operating activity? Why not financing activity? I have already told that overdraft alone is considered as cash and cash equivalent, whereas in respect of working capital loan, it is a borrowing from somebody else. So it's a financing activity. Inflow is also financing activity. Outflow should also be considered as financing activity. Pooja is asking if Ind AS 7 is applicable only to standalone and also to consolidated. Very good point, Pooja. Actually, I missed to mention that if an entity prepares a standalone financial statement as well as consolidated financial statement, you have to prepare cash flow statement for standalone and cash flow statement for consolidated. Both has to be prepared and presented. Thank you, Pooja, for reminding me that. Jitendra is asking, please repeat the concept of insignificant. I have already explained. Swarna, elaborate leasehold improvements made by the lessee. I have already explained. These points are not able to understand. Interest received on loan in operating activity, but interest paid on cash credit facility of bank is financing. How? So when I'm talking about the interest received on loan, I talked about a banking company. Okay. In banking company, interest received, I said part of operating activity. In the banking company example, interest paid also we have said it's part of operating activity. I'm not sure whether I have by mistake shown that as a financing activity. In respect of a banking company, I am taking loan, I am giving loan. Both are my operating activity. In respect of loan given, I am getting an income, interest income, part of operating activity. I am paying interest, it is part of my operating activity in a banking company. If I am talking about a non-banking company, where I have taken a loan, it's part of my financing activity. So any interest paid should be part of my financing activity. Where I have given a loan, I am not financing myself. I am actually investing in somebody else. And accordingly, to that extent, it will be part of my finance investment activity. So the loan given will be investment outflow and interest received will be interest investment inflow. And the operating activity, not possible to make it because we never include it. Lease rental paid for operating, but leasehold improvements made by the lessee is investing. Very simple. Lease rental which I am paying is relating to my rental expenses for operating the business. It is an outflow relating to that. But leasehold improvements is having more than 1 year of economic useful life. It is a long-term asset. For example, property, plant and equipment. It's a long-term asset out of which I am actually generating output. So why I am treating that as an investing activity? Because it says it's a long-term in nature. So leasehold improvements is also long-term in nature. The building will be used for long years. So that is the reason why that becomes two different things. Receivable in foreign currency at 3 million is classified. Receivable in foreign currency, you have to restate that number. If it is an unrealized foreign currency losses or income, debited or credited, you have to add it part of your non-cash item adjustment. Fixed deposit maturity after May 2020, we have already discussed that. FD with HDFC 10% original term loan for 2 years, but due to maturity within 3 months is considered as cash and cash equivalent. Sir, actually, if it is a study material, if I think that it's not mentioned that, I have seen it. In case if that is there in the study material, it has to be corrected. I will talk to the people. I have also observed another error, which I will talk to them. Sivagami, my question is not answered. If trust receives funds, can be allocated under which activity? First of all, for trust, Ind AS will not be applicable. So accordingly, you can forget about Ind AS 7. Suppose if a trust has to prepare because it's a level 1 entity under AS 3, whatever funds which is collected, for example, donations, it will be part of its operating activity. Prashant, what about cash balance in a bank against which moratorium is issued by the Reserve Bank of India? Will be a restricted cash. You have to disclose about that as part of it, but you have to actually take that as part of your cash and cash equivalent. The company buys back the shares. What activity we have already talked about. Trust receives funds. Shivagami, I have answered this. how will income tax refund will be treated? The income tax payment will be deducted as an outflow in operating activity. Income tax refund will be added to the operating activities cash flows. That's all. Okay, Lokesh Mittal, Board of Studies, because there is name of faculty of the previous class. Vijay Kumar Nayak, do we need to take balance of foreign bank which was freezed in cash and cash equivalent? Yes, no other alternative. But because unrestricted cash and cash equivalent is one word which we are using in Ind AS 1. So accordingly, that will part of your cash and cash equivalent unless it's a fixed deposit. But only thing is it is not immediately available for use, so disclosure has to be taken into consideration. Deposit accepted and deposit repaid may be financial activities. How it is operating activities? It is relating to a non-banking finance companies that accordingly, that is actually saying that it's part of the operating activity. Priyanshi Arora, what type of taxes? All taxes which is relating to the business. Deposit accepted, deposit paid by bank operating activity. That's what I explained to you. Private sector bank deposit accepted or financial activity and not operating activities as given in your example. Maybe I stand corrected. The deposit which they are talking about and deposit which I have talked about may be an error which I am talking about. If it is given as part of your financial activities because they are saying that I am taking a finance from the party. So in NBFC also that is actually going as part of that. I stand corrected. You show as part of your financial activity. Dividend distribution tax will be part of the financing activity we have already discussed. Lease rent we have already talked about. Right of use asset is actually a non-current adjustment because financial liability, lease liability as well as non-current right of use asset will come with the same adjustment. To that extent there will not be an issue. Purchase of shares in Abu Dhabi is why investing activity, why not financing? I am not financing. Financing means somebody financing me, whereas I have invested in the subsidiary of another company, right? A subsidiary of my company, another entity. That's the reason why it is investing activity. Purchase shares should be financing activity. No, when I am purchasing shares, it is investment in another entity. Only if I am buying back my own shares, it is a financing activity. Company purchase some asset and issue shares, same amount, no cash outflow. In that case, it is a non-cash transaction, but disclosure is required. Pooja says how to write answers on question to identify operating. Will it be okay if I write name of the activity and will it has to be explained? Depending upon the marks. Suppose if it is a short, you can simply say it's an investment activity or financing activity. If you are having more than 2 marks, that goes to 4 marks or something like that, you are expected to explain. So you have to explain. Banking company takes 100% collateral with FD and issues bank guarantee. Whether bank guarantee is an operating activity. So bank guarantee itself is not an asset or liability, right? It's only a contingent asset or contingent liability. So cash thing will not come. But the deposit which I have given is an investment activity. Okay, Shash Kumar, I have made that error and I get corrected on that. I have already told that it should be treated as financing activity where the deposit accepted or deposit given is a financing activity. Rahul, consolidated illustration purchase of license from manufacturing special can also be classified as operating as the question does not specify the nature of the business. It's okay, but only thing is when you are purchasing a license for manufacturing, it's a long-term asset. So accordingly, it should go as an investment activity only. It cannot go to operating activity. Mayuri is saying how license purchase for manufacturing can be investing activity. As I have explained, long-term asset. Naturally, it's like a purchase of an intangible asset. So it should go into the deposit accepted in study material. I stand corrected. Sorry. Maybe I have missed it on a quick reaction basis. Vijay Kumar Nayak, franchise fee paid or royalty paid will be part of your operating activity. What about treatment of balance in bank account against which moratorium I have already explained? License fee for manufacturing of special drugs. It's not a license purchase is intangible asset. Please understand. If you are paying a royalty is part of your outflow on operating activities. Aruna, thank you for your appreciation. Can we assume that manufacturing of drug is core business? In that case, purchase of license. Everybody is making the same error. Purchase of license is a long-term intangible asset purchase. Accordingly, should be treated as part of investing activity, right? If I am purchasing raw material, then it is part of my operating activity. Please understand, long-term investment in property, plant and equipment, intangible asset, investment property are considered as part of investing activity. In this example, we are actually talking about. Suppose if the question does not contain which method you have to prepare, better prepare as indirect method. That's the easiest method. Why it is not usually very difficult to get all the information? That's the reason why it is not used, Jitendra. Will both the method give same answer? It has to give. If it is not giving, your answer is incorrect. Can you upload examples and illustration questions? I have already given to the Board of Studies. They will upload it. Sent a query on India's 8. Board of Studies will answer this question. Unrealized gain for the purpose of foreign currency transaction. I restated the year-end balance, but it is not collected. So that means it's unrealized. Can you please explain reconciling item in foreign currency? I have explained that. What is turnover quick? I'm not able to understand. Voice is not coming clear. Maybe because I'm a little away from that. Now it must be coming. If I'm taking the virtual classes and reading all the PPT as provided during the classes is sufficient. You are asking me to give. Is it enough? See, for learning, nothing is enough. And this is a professional examination. So, always the institute study material, the way in which people will normally suggest institute study material, virtual classes, whatever we are sharing, plus last minimum 5 years of revision test papers and your, your practice manual is the best way of preparing it. And if you need something more, then you think about doing outside the books of accounts. Otherwise, just listening to this alone, whether it is enough to pass the examination, I am misdirecting you. Always I see that it's a professional examination where your knowledge will be tested and accordingly you have to prepare well in detail. So please go through all the study material, virtual classes, whatever we are talking about. Sometimes I have made an error, you have corrected me, right? So don't get carried away with that. And another thing which I wanted to tell you is that please put all the practice manual questions for at least 5 years. So 5 into 2 is 10. 10 question paper you will be answering for each subject. That will give you a lot of comfort. Even a small hitch or hint which is there, you will be able to understand. So just don't rely on only the virtual classes, but prepare well. Employee stock option plan, price paid by employees. In an employee stock option plan where I have said it's given free of cost. So accordingly it is a non-cash item. Suppose if you are collecting certain items as identified by Mona, that amount which you have collected as a concessional fee will be part of your cash flow statement. In your, it is investing activity? No, it is a financing activity because they are going to be a subscriber to your share capital, right? So accordingly, it will be part of your investing activity. Case study, should we talk about 75,000 as investing activity? Yes, we have already discussed that. 2 million study material case study. What is the treatment? It's part of the closing balance, the 2 million of the cash. TDS payment for employee salary and other expenses to be classified. So when you have deducted TDS, it is actually sitting in TDS payable, right? It's part of the current liability, but it's relating to your business. So when you are doing the working capital adjustment, what is the current year outstanding liability or other liability minus your previous year liability? That becomes your adjustment in working capital, part of the operating activity. Net amount has been paid. We have already taken an example. ESOP is issued for cash. It will come as part of your financing activity. I want to listen you for revenue recognition. Is there any lecture available? Okay, I don't think that I'm sharing. I also have a YouTube channel where I am posting a lot of the India standards. India's 115 is not yet posted, so you can look into that. I'm not sure whether 115 has been allotted to me. If it is allotted to me, definitely I will be part of that. Okay. Okay, we have seen all your questions. So, thank you so much. You allowed me for 30 minutes to answer all your questions. Whatever further questions which you are having, please post it in viewers channel, and I will be able to get that questions and I will answer that. With that, I close the session. Thank you so much for your patient hearing, and I wish you all the very best. Stay home, stay safe till such time this issues relating to this pandemic is getting completely over. With that, I close this particular session. Thank you so much again.